Right.
It's measured in squared, so we can't interpret it because uh, it's not in percentage, it's not in ratio, it's not in dollar. You can't interpret it. So the reason why the we're now standardizing it right now to get we are standardizing it. What do you say the formula of covariance was?
Covariance. So I'm looking at that of because I have this formula for two assets, and I would
Yeah.
take variance, let's say, of A and B, or X and Y, equals, and I have this from my book. I don't know what E is. I guess E of X minus E. Could you just show me the formula? How would you calculate the she doesn't really have the covariance in her notes. She has the correlation coefficient, but not, so I had to go back and see the
Okay. Now
covariance.
there are two ways of finding covariance. Covariance for what do you call it? The covariance for a group asset like this. We go back to the Excel sheet. Let's solve a covariance. If I put in okay, you were reading a formula right now. You said
Can you just tell me what the formula is? We can't use Excel, so I need to know the formulas.
okay. The formula is x minus x bar multiplied by y minus y bar. Sorry, minus y
Okay,
bar.
hold on. Can you say it again?
Yeah,
Equals.
x
Okay.
minus x bar is summation x minus x bar multiplied by y minus y bar. Sorry, y bar. If you have probabilities, if you have probabilities,
Yeah, this is different formula than my book.
the same formula. It's a I can put in the form. You use the same as in the formula you were saying is exactly what I'm pointing out. It's the same formula. Look at this. I saw the same formula here, and that's exactly. Let me just pull
What
that
is
formula.
the notes in the book?
Yeah, it's here. It's there. Now look at it.
Sorry, I can't
It's
really
x
see it.
67. Let me just increase it. Can you see it?
Yeah, that's better.
Yeah, this one. Look at it. This is the covariance of xy. This covariance. This is
It
called
just was so confusing to me because I feel like there's like 5 different formulas for the same.
Okay. Let's look at.
But what's the most standard? Because even in this book,
Yeah.
they have. Let me see. Where was I thinking?
Yeah, they have two formulas. They have two formulas in that of covariance. The covariance it looks like the variance formula. You remember in the variance formula you use x minus x bar, right?
No, because I just looked when I was looking at the variance.
Ex ex is the same thing as the mean. It's the same thing as the expected value of asset A, which is also known as the mean. That's what ex means. E is expected value of x, ey is expected value of y, and they both give us they are both known as the mean.
But then, what is
This stuff
x?
x
What is y?
this x to base I, right?
What is it?
X to base I. If you look at that Excel sheet, those are the values. Those are the values of the observation values of x. So let's say if you look at the Excel sheet, xi, can you see it? We have 10,
Yeah.
we have 12, we have 15, we have 10. These are the values of x. So the expect because we are dealing with expected value, e bracket x. The reason for an expected is because we have different values, and so we have to take we have to do an average value for all of them. So
Sorry, I'm getting really lost. Only because I
okay,
feel like I can't figure out which formula to use. So if
okay,
you
okay, okay.
you had given the formula of sum x minus x bar times
Yes, yeah.
y minus
It
has a different one, and then those notes have a different
okay.
one.
It depends on the distribution. For example, if you are given now look at this question. Look at this question in this place. Let me open it.
That one.
Well, this question this question, if you are told to
This
find
from the
this input,
solutions or the question? This is the solution or the question? Which
okay,
number of question is it?
67.
But what does it have a number of the question?
Okay, wait. Do you have like a question?
Yeah, I sent that because what you're looking at are the
Okay, okay,
solutions
okay, okay, I can see it now.
that seem to coincide with yours.
Yeah, I've seen it. I can see it now. Okay, let's do this. I'm going to do this. I'm going to do this. What do you call it?
So maybe we could do that because I'm getting really confused.
Yeah, it depends on the distribution. If you are given a ungrouped distribution, that's when you use that formula x
I don't
minus.
know any of what that means. So if
Okay,
can I just ask a couple of
okay,
theoretical questions first before we get into the problem sets that maybe will
okay,
drive these
okay,
formulas into my head better. On her notes, um, so the notes in the Word file, there's the
okay.
opportunity set with N risky assets. Can you just explain what that graph is trying to tell me? Or actually,
This
first, can you explain this, the minimum variance portfolio graph?
okay. Now, what's your best understanding of what variance means?
So when I think about variance, I think about how the stocks differ in terms of price volatility.
Okay, I like that. So you are looking at it from in terms of volatility, right?
And
What's
volatility,
your definition of volatility?
like I can think about price fluctuation and how why that creates risk in a portfolio when stocks are more volatile. Like I get that concept.
Yeah, that's yeah, yeah. Thank you. Variance is it tells you about you can look at it from volatility, right? Or you can look at it from a risk point of view. If you expect the stock to go up $15, but it's actually gone down to $8, or it's actually going up to $18, the deviation, the actual, the actual values, the difference between the actual values to the expected values, that is the that's what variance captures, the deviation from from your expected value. So now in your portfolio, why do you set up a portfolio? You want to invest, right? Let's say you want to invest in the stock market, right? So let's say you want to invest in Google. For a one asset portfolio, you invest all your money in Google. But portfolio, because one of the principles of investing tells you that you must diversify your portfolio. That's why you have a two asset portfolio, so you can invest in two different stocks, or and maybe two different stocks in two different industries, so that when one goes down, the your other you won't be having two in a portfolio that has that in which the returns go down together, right?
Right.
Now, that's just talking about the return on your portfolio. We're not trying to diversify away the risk. As an investor, you want a situation where you want your portfolio will carry the lowest risk
Right.
investment you make. So in every a rational investor, if you have two portfolios, right? This one gives you 10% return, the other gives you 10% return. Now, which would you choose? The first investment gives you 5% risk, the other one gives you 9% risk. Which would you choose?
The 5% risk.
Thank you. That's what it means by minimum variance portfolio. The portfolio with the lowest risk. You'll be willing to invest in a portfolio that gives you a return for the lowest risk. You will not blindly go into another portfolio that has a higher risk than one that has the same risk but has a lesser risk. So the minimum variance is looking at the lowest risk for every investment you put in your portfolio. Now, there's what you call
Like when I actually look at this chart again, like I
okay,
understand that and
okay,
I understand, just the efficient frontier and capital market line. But when
okay,
I look at this chart,
okay,
it doesn't. So if A is one stock and B is another stock,
okay.
and and then it's saying here's the return for the risk. I just am having a hard time. So is it
Understand?
telling you should be
Okay.
investing 50% in each? Like because like I can't. I don't know why it's not clicking what this is
Okay.
actually.
Yeah. Look at this stuff now. From what I can see that the return for A. If you look, can you see A, right? A,
Yeah,
point it, take it to the y axis. It's a high return, right? This
higher
A is
return.
telling that if you invest all money you have in just asset A, you would have a very high return on the y-axis. You would also have a high risk on the x-axis, the horizontal line. The same goes for B. You'll be having a lower return and you'll be having a higher risk.
Right. So
But
if you were to choose between A and B, you would think you would want to choose A because you have a higher return for the same amount of risk as B, basically.
yeah, that's actually the efficient. That's an efficient portfolio because you're having you're having somewhat the same risk but for a higher portfolio. But the minimum variance portfolio is looking at MV. It's telling you that you have the minimum variance portfolio is telling you that it's more better than investing in B. It's telling you that you have a higher return than what you have in B, and you have a lower risk for the lower. It's telling you that when you invest in both portfolios, it doesn't really say 50-50%. It's saying that when you start putting when you start juggling around investing in the moment you invest in both of them, your risk will drop. That is the one of the principles of portfolio investing. The
So can you
portfolio,
again, because still when I look at this, all I can see is I don't understand why you would go to the MV dot to invest or what that actually means. Because like I said, it just seems like A, you get more return for the same amount of risk
yeah,
as
but then
follow it.
you get more risk. Yeah, you cannot put all your this stuff is telling you that truly investing in A you get more return, but you get more risk. Do you know? Let me now explain what this standard deviation tells you. This standard deviation tells you that you could have a return of 12%, but you could have a variance of 20%. Variance looks at different definitions. Variance means that you must be willing to suffer for some losses in the short run. In other words, your portfolio could go underwater. All the money you invested in A could go underwater. If you lose if the moment you lose everything in A, you lost all the money. So you can have high returns. Why is it that hedge funds don't invest? Hedge funds or companies they don't just put everything in you don't just put everything in Google, or you don't just put everything in what do you call it, Microsoft. The reason is because the risk attached to investing in this, it could be a market risk or it could be a firm specific risk. this could bring your portfolio down to zero. So don't just look at the fact that you're earning 20% on it. You should also look at the risk. Now, in order to prevent your portfolio from having so much risk for investing in one asset, try to invest in two assets so that it's called unsystematic risk. The risk
Right.
of just
Yeah.
investing in one asset.
There's
You are diversifying your risk across different assets. That would bring your portfolio risk down automatically. The moment you add one more asset to your portfolio, it now depends. If that asset is in another industry, your risk, your unsystematic risk, that's the risk that variance captures, the risk inherent in this particular industry or in this stock. So when you add another asset with a different unique risk or different unsystem with a different unsystematic risk, unsystematic risk is the risk that is not a market risk. It's a risk that belongs to that industry itself. For example, Google. Google,
why wouldn't an investor just invest in B because it has that
it
low?
will make sense,
You're not
right?
making enough, so you're trying to maximize your return and you're minimizing your risk by investing in both, which is the essence of diversification,
Yes,
anyways.
yes.
Yeah,
That's why you'd prefer to invest in MV.
because
For
A
example,
risk,
pension.
but B doesn't have enough return.
Yeah, B has higher risk, but then it has lower risk. If you compare A and B, I would choose A because A is more efficient than B. I mean, we're having the same risk, but I'm having more returns.
Right.
But it's more better to have MV than A. Now, there are different parties. This is for a general investor. There are different parties that would look at this. Even for different investors, a diff, every investor will like a situation where their portfolio has the lowest risk. And I think that's what this minimum variance portfolio captures. Just that it's better to have lower risk and a return. Obviously, the minimum variance portfolio is better than the inefficient portfolios. It's less risky than having all your investment in.
Okay. So then,
And sorry, just quickly look at this correlation AB. The moment correlation AB equals 1, it's telling you that you have 100% correlation.
yeah, those I understand. And negatives that they're
Yes.
one's going to go
Yes.
up, the other is going to go down. I understand that.
Yeah.
So
So
then,
negative correlation.
yeah. So I'm
So like,
thinking.
should we do that question? And let's use the covariance formula. Then we can look at where two of them come up.
Could I just ask? So I sent the problem sets for this chapter. The first, so it's really two chapters that this one topic's covering. Could we just
Okay.
look at each question one at a time? So there's the problem set that just
Oh,
starts
okay.
with 5.1, and then there
Fine.
is the corresponding answer key. But I'm thinking that's going to help me to make some sense of, because, yeah, just to make sense of the formulas, because I'm much better when I can just apply actual numbers than letters. I hate the letters.
Okay.
I just feel they're so inconsistent. If somebody could write a textbook with the same letters to read through. Hold on, let me just find. So chapter 5. Okay, chapter 5. So there are the
So we have 5.1, right?
5.1. Yeah. So all, like, I started reading through these after I went through the chapter, and it's still, I still can't make sense of what the questions are saying. So if I, okay, so let's just even say the first problem. So that 5.1, historically, the empirical distribution of stock prices on the New York Stock Exchange have been skewed right. Why? So the reason stock prices are skewed right, and it's and even reading this graph in the do you see the solution guide too to it?
Okay, now I'm just when I look at this question, it tells me that they call this stuff log normal distribution. Do you know that stock prices they can't go below $0? You know that
Mm-hmm.
they cannot go below $0. That's why they have to be skewed right. If they are skewed left, that means they can enter -1, -2, -3, -4, -5 for asset prices. For asset prices, you cannot. It stops at zero. So from zero to the end, from 0 to 100, 120. That's when. And that's not a normal distribution. If you remember your normal distribution, it's bell shaped, right?
Well, it's confusing now to think about normal distribution because to the
Yeah.
right of the mean would no, it's just the mean. So right, so nothing can be negative. Um, so it's
Yes.
not zero,
It's negative.
right?
Normal distribution, right?
That makes sense.
In percentage terms, you can have it. In percentage terms, you can have a normal distribution of returns. After all, for example, if you have a stock price today that is $10, right? $8.
What is it?
The percentage returns is mine. The percentage return is minus, right? You can set this up. The distribution of returns, you can set it up on a normal distribution. You would have minus going left or plus going right. But stock prices, they are given in dollar sign. They are not in returns right now. The stock prices on the NYSE, they are skewed right because they start from $0. Their minimum value is $0, and they have infinity, depending on when they can go. That's what it means. That's why they are skewed right. They have a minimum value of $0. They cannot fall below $0.
Okay, that makes sense. So then
Yes.
the next question starts getting me very confused. So I think this goes, so 5.2 is going to go
Okay.
back to just my understanding of um, just that how, so it's asking, and this, I cannot follow the math. This has always been my problem. So given the following relationship between X and Y, again, what's X, what's Y? The price of the stock, I assume?
Okay. Can you
Or
remember?
no. Okay, so now this is getting to the linear equation. So, right, so prove that X and Y are perfectly negatively correlated.
Can you remember the role of independent and dependent variables? Y,
Yes.
dependent variable. A, constant. B, the beta. Sorry, B is the yeah. B is the beta. X is the X is the independent variable. Now let's look at this note. Y equals A plus BX, right? And they give us a condition B is less than 0. Now, Y, let's write that Y is dependent variable.
Are you writing on something?
Yes,
No.
I'm writing
I
on
don't,
a book.
are you writing it so I can see it or no?
Uh, okay, give me a second.
If not, that's
A,
okay. No, I
okay,
didn't see it.
yeah, we can write that. We can try and write down Y equals A plus BX.
Right.
Y is dependent variable. A is what you call Y-intercept.
A is
This is
what?
Y-intercept. It's also known as intercept.
Oh, the intercept. Yeah.
Yes. X is the independent variable. and B is the slope of the equation.
Right.
Now, let's define this equation. This is a regression equation. It's telling us
Yep.
that y is a, now what is A? A is a constant. It's a constant. A is telling us that if you have, it's called intercept or y-intercept. It's saying that, let's say for example, let's look at two variables that we feel have some relationship together. Can you give me two variables? Can you give me two subject matter that happen to tell you if this one goes, this one will happen, like a cause and effect relationship?
Um, uh, I guess gas prices and or
Cars?
I don't know,
Yeah.
cars.
The gas prices and purchasing a car that uses gas, right?
Right.
Do you know that not in almost cases there are different factors that play, but let us assume that if we hold constant your disposable income, if we don't say it rises and we don't say it falls, if we hold it constant and suddenly there's an increase in the price of gas, how do you think you would feel?
Um,
It may discourage you from going to buy a car.
right.
It may discourage you from going to take a loan on a car, so you can start paying up the loan, because why? You're getting more it's getting more expensive for you to run to be able to maintain your car, right? So we can say that now we've seen a cause and effect relationship between them. The increase in gas prices will lead to a lower demand for cars that use gasoline. Now, if that happens, yeah, let's just keep it at that. Let's not make it complex more than that. Now, why will be gas prices dependent? Because I'm sorry, uh, the demand for cars, the demand for cars that use gasoline is dependent on the price of gas. It's dependent on gas prices. So X is gas prices. The demand for cars that use gasoline is is the dependent variable. Now, A tells us that if we find out that there is no change in gas prices, that is, nothing happened to gas prices, what will be the demand for cars that use gasoline if there is no change in the price of gas? Then you now you- now you
Uh,
then you have to look at other
Zero,
factors.
because it's not going up or down.
Yes, if A tells us that if X is zero, in other words, it doesn't matter what B is. The moment X is zero, the right hand side equation Bx will be zero, right?
Right.
Zero multiplied by anything is obviously zero, right?
Hmm.
So it means that Y will be equal to A. That's what the Y-intercept tells me. When X is zero, what will be Y? That's why it's called Y-intercept. Now, if there was no change in gas prices for just this one model, this is a model that is one because we only have one independent variable. This is a one independent variable model. Now, you now have to look at other factors that lead to the demand for cars. Number one, disposable income. If you have a greater disposable income, higher salary, obviously you can save more and you can buy a car or take a loan on a car and then start paying it off. It could also mean that families are maybe a family, maybe you're going to be having you're expecting a child in the family, and then suddenly it means that you have to start transporting to and fro. Different factors. For this one independent variable, A is going to be large. A is going to be large the moment X is zero. Why? Because you cannot say that gas prices is the only factor affecting the demand for cars. A could be large, A could be small, depending. So the
So sorry,
moment you make,
I'm getting lost in it only because I'm looking at the solution and it's
okay, don't
insane and
look
I
at the
can't.
solution. Don't look at the solution. Let's relax, okay? Let's look at this equation. Now, this question is very simple. I just want to explain explain this so you understand why it's dependent, right? Dependent variable, right? It's y. Okay, let me just read this equation. Y is a function. Y is dependent on A plus bx. What does that mean? It's telling you that the demand for cars that use gasoline is dependent on A. What happens if we find out that there is no change in gas prices? If we find out that the independent variable is zero, what would not, as in what would be the usual? What would happen if there was no change in economic activity? What would happen to your buying power? That's just what A does. Now, plus B. What is B? B is telling you that if you find out that there is a change in gas price, how will it affect your demand for cars? Now, look at this. For example, you find out that, if, for example, in your workplace, they give you uh, a flat $100 bonus. I want to ask you, will you spend that $100? Will you spend it completely? You would.
I don't know. Sorry, I'm feeling just really overwhelmed.
You want to wear some? You want?
I'm just wondering. I'm trying to figure out even the best use of time to understand.
Okay, okay, chill. Can you see me here?
I
Come
understand
here.
it's to solve the problem, but I think it's outside of the
Okay,
scope.
chill,
So,
chill.
quickly. So I'm like to the point where I just need to know the.
Okay, I can be faster. I just want you to get it. Okay, if you want to get if you want to get what do you call it, the answer, answer, the reason why B negatively correlated is because of B. B is zero. B is less than zero. What does less than zero means? It means that it is negative. That means for every change in X, for every, it's negative. So it means that if X should increase by 1 unit, by $1 or 1 unit, B and Y will fall. Y will fall by, Y will actually fall. B is telling us what a change in X will translate to in a change in Y. The reason is clear is because the reason why B
So
is the
if
slope.
I
Yeah,
do know this, I just can't think through it. X increases by $1.
yeah. B
Then what
tells
happens?
if X increases by $1, B, it determines, B is what determines the flow of X into into Y. In other words, if B is 0.2, if X increases by 1, Y will increase by 0.2.
If B
But if,
0.1,
yeah, for every 1 unit increase in X, Y will increase by 0.1.
hold on a minute.
Yeah. Write that down.
I
Write
know,
that
but
down. B. Let's write the formula for B. B is Y1, sorry, X1 minus X2 divided, X2 minus X1 divided by Y2 minus Y1. That's actually the formula for this, for its slope. It's telling us that
X2 minus 1 divided by Y2
2 minus
minus
Y1.
Y1.
Yes. That's the formula for its slope. The slope B is telling you that for every change, for every 1 unit in X, Y will increase. For example, if B is 0.2, okay, let me define B normally. B, this B is the slope of the equation, which tells you that for every 1 unit increase in X, it tells us the change that would it tells us the change in Y for every 1 unit increase in X. Yes. B is the change in Y for every 1 unit increase in X. It's because the reason why it is because the dependent variable depends on the independent variable. So if there is an increase in the price of gas, which is the independent variable, how would that lead to the demand for cars that have gasoline? So the moment B is less than 0, it's telling us that, let's say B is -1. That means for every 1 unit increase in X, Y will reduce by -1.
Right. Maybe we could go on to the next problem. It's just I'm not getting it, and I can't.
Okay.
I understand.
Is
Yeah.
B is the factor that actually determines this. They're negatively correlated because the slope is negative. It's less than 0.
Right.
We'll come back to it. Okay. So let's do this one. This return. Can you open your Excel sheet? We can just fix this one. Let me share. Give me a second. Let me share this screen. Can you see it? Can you see the Excel sheet?
So what I'm thinking, I'm just trying to figure out how I can understand basics. I think.
Yeah. I want you to try and relax. Okay, we'll fix this. Can you see the Excel sheet?
No.
Can you?
Yeah.
Okay. Now let's fix this. Let's fix this. Let's fix this. Then.
Maybe
Now.
instead of this problem, I'm not even going to think about this problem. I'm going to go back to the notes and now just try to understand the formulas for the covariance.
Okay. Let's. Yeah. We.
And just to stick to the basics, because it's just
Okay.
I can't think
Yeah.
about how this relates to these other things.
Okay.
I know what you're.
Look at.
It's just then looking at
Yeah.
the breakout of the solution. I cannot follow those letters. And
Okay. Let's look at 5.7. Look at problem 5.7. 5.7 is a two variable situation. Let's find the mean, the variance, and the covariance. We can use it to get the formula. We can apply the formula to it.
okay.
We can actually know which formula to use.
So
Okay.
given two random variables,
Now,
calculate the mean and variance of each of these variables and the covariance between them. Okay, so
I'm using Excel. Let's do it on Excel. You pull up your Excel. 0.2, 1, 2, 3, 4, 5. 18, 5, 12, 4, 6. Is your Excel open?
this is number 7.
5.7. 12, 1. Yeah, I already set up my Excel. In this one, you will not use it because there are different ways you present data. Here we are dealing with the probabilities that are attached in this formula. The covariance is going to be we're going to alter the formula slightly.
Right. So
Yes. So can you see my Excel?
Yep. So what I'm thinking, just in the interest of time, maybe I'll have you, well, let me just see.
Want me to fix this assignment and explain them?
Okay. So this is translating the first.
Let me you there?
Right, so I understand how the mean is calculated by multiplying. So if I go back just to my 2-asset model and coming up with the expected return, which is the mean, multiplying.
Yeah, you multiply the probabilities, right?
Yeah.
Let's find the mean of x p1 multiplied by xi. So that would be equals to 0.2 multiplied by 18, right? And then we'll do that for everything.
Can
So
you?
x.
Do you have your Excel? Are you doing it in Excel?
Let me do that. Can you see it?
Oh, yeah. So I see.
Can you see it?
Yep.
Okay, so equals to
No,
look at it.
I have my okay, yeah. So all right, I understand the expected,
Multiply by
and I do know how the variance.
right? So you drag it down.
Right.
So let's do the one for pi probability I multiplied by yi. That would be equals to this multiplied by this, right?
Right. So hold on. I think right. I understand that. Then
Okay. So x bar. Let's go do the main. X bar is also known as.
so I think
There.
I'm just gonna stop because I think I understand. I can follow these calculations on my own. So then, if what is B asking? Suppose X and Y represent the returns from 2 assets. Calculate the mean and variance for the following portfolios. So what is this one trying to say?
The variance.
So it's the percent. So you,
Okay, wait. Why don't you allow us calc? I think Kara, I think you're almost like jumping right now.
what I'm trying to do, because I did spend some time trying to figure this out, and I do have way more questions. So
Okay,
I'm trying
to just you're already jumping to variance. Why don't we calculate mean and then do the variance quickly?
yeah, I can see it. I can see how it's calculated.
Okay. How about covariance? We need the variance, and we need to calculate the variance first before we can.
I'm just
We
following,
don't even.
I'm just following along
We
in
don't
this
need.
to see because I,
Hmm?
I can
Sorry,
I'm
come
just,
again.
yep. So I get that. See it. I see the formula that I can use in this instance.
Okay, so let's do the covariance. Can you see this stuff? I need to find the x bar by y minus y bar multiplied by the probability.
Bar mean? When you say Y bar, what does that actually mean?
Okay, y bar is it's mean, is the mean. It's also known as the mean, the expected value of x. They're the same. You know when you have y and you have something up like a cap covering it, like a horizontal cap, that's what they call y bar. It's also known as mean, and it's the other name for expected value of x. It's e in bracket x. They're all the same.
So E in the bracket X is the same as X bar.
Yes.
So E,
E in bracket x is known as expected value of x, which is what mean explains. Mean.
is X
The
bar,
mean is the expected, the average value.
right? And then the same thing with the EY. That's just Y bar. Okay.
Yes.
That's what. That's where I get tripped up is when, like, it will start using y bar, and I don't know that that is just ey, bracket
Sorry.
y or whatever.
The reason why they use E in bracket X, it's because of probabilities. When you're dealing with probabilities, you are not looking for expected value. So it's just it's just different use of terminology. The moment there are no probabilities here, I'm telling you, you start seeing mean, you start seeing some terminology of mean and
For real, usually you're
expand.
weights versus probabilities.
Okay, it depends. Sometimes there are no weights. That's what if you don't find probabilities, that's when that's the formula you saw E. That's the formula you saw divided by n minus one. That's what they call sample covariance. The reason why we put n minus one is because the sample covariance is different from the population covariance. It's a sample must be an unbiased estimate of the population. That's why we are not making it n. We are making it n minus one because after all, we're taking samples where we don't know the population covariance. That's why it's n minus one. Okay, so wait, can we quickly can we quickly just solve the let's just calculate the mean, calculate the variance, and we'll just solve the covariance here. So the mean is the addition of this, right? Sum of this, right?
Yep.
Yeah. So y bar as the sum of the multiplication of this down. Now let's quickly do variance of y, variance of x, variance x. That's x minus x bar, right? Right. Which one are you looking at?
I'm looking at, well, do you see I sent the solutions too?
Sorry, come again.
I sent the solution, so I'm looking at, I'm just trying to follow the solution.
Okay, where is the solution?
That's in the PDF file, the finance theory.
Let me
Had it
see.
open before, so on page 48, there's the solution. So it's just
Page 48, the textbook, right?
yeah. So that's not even the textbook. It's just the solution guide. Yeah, there it is. So number 7 there.
Okay. Okay, number 7. Let's see. Can you see?
Yep, right there. So I can follow all of that. That's what I was saying. That it's just
Okay.
so like I get that whole how to calculate A and come up with the covariance. Like I get that. And now it's B, but I don't know what it's saying.
Okay, the B. The B is the B part, right?
Yes.
The B part is the expected return on the portfolio, the mean of the portfolio, which is A. A is the weight of the return on X, the amount you invested on X, asset X, and 1 minus A is the amount you invested on asset Y.
Yeah, hold on. So that's not making sense to me. So
Okay, it's just a different with
so suppose X and Y represent the returns from two assets. Calculate the mean and variance for the following portfolios.
yeah.
Yeah, so I don't even know what these numbers. Oh,
Okay. Now
okay.
let me go back to that question. The question is where's that question? 5.7. 5.7 is okay. We found in the Excel sheet we found the return, right? X bar and Y bar. That's the EX and EY, right?
Right.
Right?
So that's
Now to find the
so
portfolio,
what is A supposed to be?
A is the what do you call it? A is the amount that you invested in that asset.
The what?
A is the weight of the weight is like a proportion of the is like the proportion invested in X, the total.
Right.
Now, how would I solve how would I solve A? We're given probability 0.2, 0.2. Um, Now this particular formula, I'm trying to pinpoint a probability, a weight to give it. I can't pinpoint that weight. Usually it's one that is given. Usually it's one that is, let me see. If I put 0.2,
On the
this
portfolio.
is X and this is Y. They have to give us a particular, what do you call it?
Percent.
A particular percent for both of them.
So they give it to you.
Yeah, they gave us a list of what they call it. They gave us a list of probabilities for only X. They give us the probability for X and Y.
So since it's the
I have
return for the population now, it's or of two assets, you have to
yeah, and
follow
we have
formula.
yes, we now yeah, so we have 9.0 and we have 5.0, but we need a single probability to be able to multiply with 9.0 now, and a single probability to multiply with 5.0. Let me now see. It wasn't given. They didn't solve it. It can't, that formula does not work here.
Yeah.
That formula does not work here. But look at this. If you look at C, there is a formula for A. It's a bit complex. Look at A. A equals A equals the variance of Y minus
Yep.
the
Way over
minus
my head.
the yeah, that's like so if A is 6.64, that means B will be 0.34. Sorry, 0.36. This is crazy.
Yeah.
This is a formula. This formula for A. It's given under it's under this scenario that they can. I've never seen this formula. It's a weird it's an odd formula.
Yeah, she's using it in to calculate this minimum variance
Yes.
portfolio.
Yeah. So let me see. This is let's define this A. A is the variance of Y minus the correlation of X and Y multiplied by both standard deviations divided by the variance of X
All right.
plus the
Could I stop
variance.
for 1 second? On her notes on page 2,
Yeah.
that is the minimum variance
Page,
portfolio. Now,
yeah. Let's
thing
the minimum
I
variance
was
portfolio.
thinking
Yeah.
I was thinking that the WA and WB like were variations of that PBA or whatever. Is it like? Can I just so then it just jumps to whoa? There's a plug in there. The so that where so then it says PAB where it's the covariance divided by the standard deviations. That formula is
Yeah.
correlation coefficient, right?
Yeah, that's a correlation. It
So
standardizes. We are standardizing the covariance to make it in units so that we can measure it. So it can be we can interpret it.
So that's the difference. So the difference between the covariance and the correlation coefficient is the correlation coefficient is just easier to read. Kind of like standard deviation is easier to read than variance.
Thank you. Yes.
So then
Yes.
WA and WB.
Is the weight
What?
on asset A and the weight on.
How do those two formulas derivations of the correlation coefficient?
Yes.
They are.
They
Okay.
are, yeah, they are like,
No idea how you go
yeah.
from those formulas WA and WB to this. Is that the symbol for row AB or what's that P?
P is the symbol for correlation.
Oh, P is the simulation. Okay.
Yes. So this is like, if you look at this, is standard variance of B minus covariance RB, because it's actually the standard deviation A, standard deviation B multiplied by this. That's actually giving us covariance. So it's this variance of B minus the covariance of RA and RB divided by the variance of A plus the variance of B minus 2 multiplied by covariance of RA minus, sorry, covariance of RA RB. So it's the covariance. It's this is like an advanced derivation.
But that's what's crazy is that you need, it looks like it goes from WA and WB. Oh, it's just defining what
Yeah, it's just the, yeah.
correlation is within WA and WB. So what is WA actually giving? The actual minimum variance for portfolio A, or just A, like the weight.
No.
A. Oh,
No.
that's what it is. It's the weight of A to figure out the minimum variance. Okay.
Yes.
So
Yes.
it's
But it's not a,
how much
derivation of, I don't think it's a derivation of it. It's, this is what we need, this covariance to be able to find the weight of A.
Yes. So to
Because,
figure out the minimum
yeah.
variance, so what it's doing is, so you need to figure out the correlation, and then this
Yeah,
tells
the correlation and the covariance.
you have stacks
On,
A and B. This is how
yeah.
much, this percent is how much you need to invest in A.
Yes, for a minimum variance portfolio, a portfolio that has the lowest risk.
Right, for the lowest amount of risk.
Yes. So maybe you can just write down.
Yeah, the calculation isn't terrible. I mean, I can, all of those symbols we understand now.
Okay.
Right. So, and then in this problem, not to go through it all, but it would say, so whatever minimum variance portfolio of A, I guess.
Yeah. Do you want us to solve this stuff?
It doesn't even, this is the thing, it doesn't even give you stack A. It's like X and Y. So then why does it go to an A with a little asterisk?
Yeah. Remember, look at this stuff A. Look at B. Look at part B. Part B is A. We don't have A and we don't have A. So that's why it jumped to A.
Yeah.
And A. And then if you look at D, it came back. Sorry, if you look at the same under the same C, just look at below the graph. You see something like ERP.
Right.
It comes to use that 6.4, 0.64 multiplied by the 9 that we found up, 0.36, 1 minus 0.64 multiplied by the 5.
The weights now. And
Yeah,
now
the weight.
figure out the expected return weighted portfolio, because you need to know what the weights are to figure out what the expected return would be. So the first step is really to figure out, so you need to do, theoretically, you would need to do this. You couldn't, like, let's say, so this relationship in this minimum variance portfolio is only on 2 assets though. How would you come up with this minimum variance when you have 50 assets?
Oh, okay. I mean, that this is outside scope. You're going to have to use
I know it's outside the scope, but it's just, I guess.
How would it work?
At least
For a 50 asset portfolio, let me see. There are different weights. You're going to be, it's going to be much. Can you remember the variance formula? The variance formula is A, variance of X, plus B, variance of Y, plus 2, multiplied by A, multiplied by B, multiplied by correlation AB, multiplied by standard deviation X and standard deviation Y, or A, or standard deviation A or standard deviation B. Now, for
Hold on,
formula,
hold on. I thought it
actually
was 2AB times the
2AB
correlation. I mean the
correlation.
covariance.
Yeah, or sometimes they may not give you covariance. They may give you correlation and the standard deviation of both. They may not give you. Remember, it's so, okay. Thank you. It's 2AB multiplied by the covariance. Sometimes they may not give you covariance. They may just give you correlation and the standard deviation of both parts of both assets, or they may give you the variance. All you do is just
really confused because
okay. The formula is 2AB multiplied by covariance AB.
hold on a minute. So
The formula for variance is let's do
this variance.
let's form our formula. Let's form our own formula. Okay, let me just remove this. Let's form our own formula. Okay, variance x, okay, is w squared, w squared, w to the power 2, and then to the base a, just to tell, so that is
That's the weights. The weight of a squared, the weight of b squared.
Yeah. Okay.
Yeah.
So w squared a, sigma squared a.
Hold on. What's sigma? Oh, variance. Yeah.
Sigma variance, right?
Yeah.
Plus
sigma.
W squared.
Yeah. B.
Sigma squared b.
Yeah.
Plus 2.
Yeah.
W a.
Yeah.
W b.
Right.
Covariance a b.
Right. Now, my question goes back to this. To calculate covariance.
Yeah. To calculate covariance.
And I seem to be just...
To calculate covariance, now I think, would you permit us to go back to the Excel sheet so we could calculate the covariance?
Right, so that's that calculation. That's taking the differences. So I just need to memorize. I just need to get that covariance calculation down.
Now, if they do not give you covariance, what do you do? Right.
So if covariance isn't given.
No, it's not even if they don't give you covariance. If you are not giving if they didn't say calculate, let's say you are not permitted to go to the table and to start multiplying all those things to get the covariance. Let's say they gave you correlation and they give you standard deviation. You can find in them
if correlation
values. That's why. So the formula we saw that covariance A B divided by standard deviation A multiplied by standard deviation B is actually the correlation AB.
Hold on a minute. That's so what is A and what is B though? So you're saying if I had
covariance AB,
covariance
AB divided by B. Okay.
Like what is the A and what is the B? Those are the weights?
Those are okay. I kind of sum them. I'm kind of making the terminology a bit lower. Covariance AB is covariance of return A and covariance of return B. The covariance between return on asset A and the return of asset B. That's just, I just put it as covariance AB.
No, so hold on, I'm confused.
Covariance is looking at the movement of the two assets, right? That's why it's covariance AB.
Right. Covariance, two assets, I get that. But you're saying if covariance isn't given, then...
Yes, as in, there are different terminologies. Okay, wait, look at this. Remember what you said? You said as variance is to standard deviation, so also is covariance to what?
To correlation.
Thank you. So to be able to make sense of covariance, we standardize it by dividing it by the standard deviation of both assets, right? Because covariance is actually measured in squared. It's the same measurement with variance. So the formula for correlation is covariance AB, covariance return on AB, return on A and return on B, divided by standard deviation A, standard deviation B. That is the correlation on A, B.
Right.
So to find covariance is just to work back. Correlation AB multiplied by standard deviation A, standard deviation B. So they may not give you covariance. They may not give you covariance equals 0.5. They may give you correlation and standard. All you need to do is just multiply it to give you the covariance.
So if you just have the correlation, you
And
multiply it
yeah, by the standard deviation of return on A,
of
standard
A
deviation
and
of
B.
you get the covariance.
So you have to take the correlation. If you have the correlation, which is this P, if
Yes,
you
PAB
correlation, you can
multiplied by that's why yeah.
multiply it by standard deviation A and B.
PAB multiplied by standard deviation A and standard deviation
Of A and of B. Right. Okay.
Now, look at sometimes they will not give you correlation, they will not give you standard deviation.
Yeah.
They want you to work yourself. Now, if you are giving now, can you please look at this Excel sheet and let me just show you the different alteration of the covariance formula.
Oh, I don't see it.
Okay, let me just share my screen right now. Now, can you see the screen?
Yep.
Yes. The moment you see probability, right, the covariance formula will change in a way. The formula, just look at the side. This is the formula for covariance when you are given a data that has probabilities attached to it. It's just a variation, but the concept is still there. The formula will look like P. You know that we have 0.22. These probabilities they are the same for. These are the probabilities given for both X and Y. Am I correct? It's not like we have different probabilities, right?
Right. No, I get that.
It's 0.2. This 0.2 is for X and Y, right?
Yeah.
So the formula for the covariance will be Pi multiplied by X minus.
This is for the covariance.
Yes. P
Is it
by
X by Xi?
yes, Pi, the probability multiplied by X minus X bar. It resembles a bit of variance, but it's not. It's a covariance. So that's why it doesn't add squared. Just telling you that it looks like variance. Multiplied by Y minus Y bar. This is the formula for covariance when you are given a distribution that has probabilities attached to it. For if we just had X,
Yeah.
if we just had Xi and Yi, and we just let me go and bring these values. Control C, Control V. If we just had this, you know what it to be? The covariance. Of course, all you need to do is say sum. All you need to do is average. The average of this to get the expected value of X. This is EX, EX. For EY, for EY is just average. That's just expected value, average. And if you want to know the probability is actually divided by 1, 2, 3, 4, 5, divided by 5. It will still, I can, it's actually 0.2. They're actually telling you that the same weightings, because if you just give me this, that means you're saying they're all equally weighted.
Mm-hmm.
Don't worry, I'll show you that we can do this 0.2. we can put this 0.2, multiply this and add it together, and we still get this 9. Let's find that out. Equals to, oh, let me just drag this down. Equals to 0.2 multiplied by 18. Let's now sum this together. 9. So it's just is the definition of average. Just sum it together and divide it by the number of these values. Frequency is the same thing with this probability. It's almost the same concept. They just try. It's just almost the same concept. So let's just do the one for. You're with me, right?
No, I know what you're doing. I'm just looking at moving.
Okay, average. Yeah, let's now look at the covariance. The covariance for this one is we have to find x minus x bar.
Yeah.
We have to find y minus y bar.
Yeah.
This is this minus this. Just put the F4. And then y bar equals to this minus the y bar, the mean or the expected value. Lock it so that you don't have to do repetitive work. Now, this is the y bar. Now, covariance, we're all set. The covariance is, remember, we don't have probabilities here. They never gave it to us here, so we cannot use it. All we need to do is, this is where that formula you read, minus e raised in bracket x close bracket minus y minus e
that would make sense.
bracket y divided by n minus 1. And that n minus 1 is telling you that it's actually.
I don't have an n minus 1 on my in my covariance formula. So just as you're explaining with all those things, I would just do e.
You just multiply by this, right? Right?
Yeah. Yeah.
Okay.
Right. It's just the average.
So then you just come here to sum them, right?
Well, and then take the probability. So you're saying
minus 6.
know the probability here, right?
No. If once it's not given, you can't use it.
The probability is not given.
Yes.
The x bar and y bar multiplied by each other. And then if probability is not given, you have to divide by n minus 1.
Yes.
Only
that's 5 minus 1.
Is not given.
Yes.
And the number, okay, minus 1.
Please, let me just quickly solve it and see how the answer compares to this on this side. X bar minus this. Just lock this stuff. F4. Okay, y minus y bar. Right? So equals to what's that y bar? Y minus y bar. This is the y bar here. Same thing as beside the same guy, F4. Drag it down. Right?
In a lot of problems, you say probability is not given.
Probability, yeah. Yeah?
Generally, probability is not given.
Okay, the probability is not given, so we are here. The probability is not given. It is x minus. It is this. It is this x minus. Let me just put it here so you can see it properly. So this is the covariance. which is this, the addition of this divided by 5 minus 1. But here, let's go do this. 0.2 minus, oh, wait. There's still one thing we have to do. Control V. We have to do X. We have to do this. We have to come here and multiply them. Oh, no, we don't have to duplicate. We can just multiply them together. This is this multiplied by this, right?
All right, I get this. We can go on to the next thing.
Okay. So let me just sum this.
We can do that calculation.
Minus 1.2. If I were to take this 1 away from here.
Yeah.
Minus 1.2, the same thing.
Right.
Same thing.
Yeah. Okay, so then when I'm looking at,
you have to be explicitly told that it's a sample covariance for you to put that n minus 1.
Say that again.
Covariance x minus 1. Sorry, covariance xy given without the probabilities.
Right.
As that n minus 1.
That makes sense now.
To mean a sample covariance. But if it is a population covariance, do not put that n minus 1.
Because you know.
Yeah, it's a population. So the n minus 1 is that you are not trying to say that the sample is exactly equal to the population. So you're taking one away from it. So it becomes an unbiased estimate.
Not equal. But if you don't have the weights, you have to do the n minus.
Yes.
Oh, the weight, yeah. The probability, I mean. Probability or weight.
Yeah, probability or weight. So if you have the probabilities, you just multiply them together. I need to find, let me see. Let me go see that formula, because sometimes that n minus 1, I know it's sample covariance, but sometimes I quickly need to look at where it's a sample covariance. It's almost like, okay, now look at this. Look at this stuff here. Can you see this covariance here?
Yeah.
Look at this. It says, no, this is for a 3 asset. Let me look for a 2 asset. No, this is a 2. This is a 3 asset. This is a 3 asset. Let me look for. Okay, look at covariance. Okay, this is just giving us another version of covariance. Correlation multiplied by the standard deviation of both of them.
Wait, can you go back to that one with the R by the 2 variances?
Yeah.
Right, so that's saying R.
That
That's why I've seen that.
R is the correlation. They are the same. They are using the same terminology. RXY is the same thing as PXY.
RXY is the same as PXY. Okay.
Yeah.
Yeah, that's when I get confused.
Sorry about that. And one of them happens to. I think one happens to be sample, or one happens to be population correlation. I'm thinking, but they are the same correlation.
So
They're the same terminal, the same number.
So it's taking, right, so you told me that. So it's just taking correlation times, oh shoot, I had that it was, I mean, I thought it was variance, but it's standard, that's standard deviation, right? Sigma squared is the variance.
Yes.
I had it as sigma squared, right? Okay, so they're taking that. So R, okay, so R XY is correlation. Yeah. Again, at this point, this is a little over my head. I'm still trying to know that RXY and PXY are the same thing. But, all right. Okay, so now if I could ask, when it gets to more assets,
So you want us to deal with the question now?
No, not yet. The question.
Okay,
What did you say?
what do you want us to do right now?
I keep questions. So moving on from the multi-asset portfolios, because I can follow the formulas in her notes at least. When it gets for more assets, the equation that she has on her page 3, it says for more assets.
Yeah, right. Nice. So
So
this is the risk and
so it's taking the weight times the expected
yeah,
return for
yeah,
each of
for
however
each.
infinite number of assets. But now for
Yeah.
the variance, it has these two summations. So what does that mean? So it's
Thank
so it's like the
It's the same thing. For a two asset portfolio, remember we did A is the same thing as the weight of A, right?
But are you looking where she has for more assets, like just where it's like the
Yes, that's what
WIWJ? What are those letters representing?
okay. The ERE expected value of the return on the portfolio equals the weight on each asset multiplied by the expected return on each asset.
Sorry, am I looking at the right thing? So this is on her formula. It's just
So we're looking
four
at
more assets, and it's var RP equals the two summations WIWJ sigma IJ.
yeah.
So no sigma
Okay, now that
covariance, right?
sorry, come.
Sigma IJ is covariance. Just like
Yeah.
I was following it all, but then when it switches to saying W's instead of A's, like I don't know. So
I wonder why. I don't know why your prof is using this A. It doesn't make sense. This W is the same thing as A. What
right,
kind of prof is this?
that again.
I'm sorry about
What is something in the book? This Copeland
sorry about It's actually W. It is the same weight. They are that YJ is just telling you for different assets, multi assets. YI
So
is the
it's
Y.
like as if it's the weight of A and the
You know?
weight of B.
Yeah. And the standard deviation is saying that standard deviation of I and J of the different assets, because standard deviation is key. It will be used in calculating the variance of the portfolio, the variance of the return on the portfolio. Remember when we dealt with covariance, when we had to say 2 multiplied by weight of A multiplied by weight of B multiplied by covariance, and the covariance is the correlation multiplied by the standard deviation of both assets.
Right.
Right?
Right.
That's why they're using. You don't need to worry about this formula, this one. But this one is just trying to tell us that this is infinity of assets weight multiplied by their standard deviations. So you want us to fix this formula quickly?
What?
This formula for a 3-asset portfolio, it will start with A. This A is already entering my mouth. Let's use W. WA standard variance of A plus WB squared variance of B plus WC squared times variance of C plus, now you deal with the first one that relates to A, covariance AB. What is it? 2 multiplied by WA multiplied by WB multiplied by covariance AB. Go to the next one. AC, 2 multiplied by WA multiplied by WC multiplied by covariance AC. Go to the next one. We've dealt with AB and AC. The next one will be BC. 2 multiplied by weight of B, weight of C, multiplied by standard deviation B, standard deviation C. We can't do BA again because we already have AB. We cannot do CA because we have AC.
Yeah.
So it's clearly split. Covariance AB is same thing as covariance BA. So AB, AC, BC. Now it becomes a bit longer when you have correlation, when you have 2AB correlation AB multiplied by standard deviation A multiplied by standard deviation B. That correlation and multiplied by the standard deviation is just covariance. That's the formula for the covariance. Another
The sigma ij is covariance.
no, sigma ij is the standard deviation of multi-assets, different assets. I for different assets is just they're just trying to, that's just the best way they can sum it up, because we are already dealing with different we're dealing with standard deviation there.
But it doesn't make sense to me within the formula because it's like the covariance of
yeah, you're hoping to see that there, right? I perfectly understand the one for ERP, but this particular variance of RP, it makes it a bit simple.
Yeah.
It makes it look like why.
It is like in this book. I see. I mean, she pulled it right from the book, and it's using this exact formula.
Yeah.
Yeah, and it's doing the WIWJ sigma ij.
Yes, that's the weight of different assets, right?
Yeah, like I get it. Like I get what the formula above is saying, where it's the same var RP, and I know that this is just doing the infinite amount, but it's just when I see these other letters and I'm trying to translate it to, like that previous, it just doesn't.
Okay, I got it.
Make sense.
Okay, I found the reason. What's the formula for covariance again? Using correlation and standard deviation.
Yeah, correlation times standard deviation of A and B or whatever.
Can you solve for standard deviation A and B? What do you get?
No.
Can you solve for covariance using covariance using making standard deviation A and B the subject of formula?
No. Yes. Oh, could I solve for correlation?
Solve for covariance using making standard deviation AB the subject of formula. That would be standard deviation AB equals to covariance AB divided by correlation AB. Do you agree?
Yeah, I can't think like that.
No. It's not. You don't have to think like that. What's the formula for correlation? It's covariance AB, right?
Mm-hmm.
Divided by standard deviation A multiplied by standard deviation B, right?
Right.
Now, make standard deviation AB the subject of formula. Just bring one up and take it down. So the standard deviation AB, standard deviation A multiplied by standard deviation B equals covariance AB divided by correlation AB. Just solve for it. This is mathematically possible. You just solve. We're trying to solve for. If you have one, you can solve for. If you have two, you can solve for one. Right? Just as we found covariance AB by multiplying correlation AB by the product of the two standard deviation. So let's solve for standard deviation A and B.
So solve for standard deviation A and B.
A and standard deviation B. It's actually it's a product of both of them. Standard deviation A multiplied by standard deviation B. So just mix the formula and make standard deviation A multiplied by standard deviation B subject of formula. What do you get?
I don't know. I don't know what you're saying.
Okay. No, you already have the formula. Relax, Kara. Can you tell me the formula for correlation?
covariance of A and B divided by the standard deviation of A times B, standard deviation B.
Yes. Can you mix the formula? Solve for standard, make standard deviation A multiplied by standard deviation B. Let it be the square root of formula. Turn it upside down.
Okay.
And do that.
I don't know what you're trying to say or do.
Good. That is what they did here. They didn't put, remember the focus here, variance, the variance of the return on the portfolio, right? This formula looks at 2 multiplied by the weight. It has the covariance formula there at the last. Standard deviation I and J is basically equal to covariance I and J divided by correlation I and J. They're trying to make it simple for us.
Well, it gets really confusing when I look at the diversification, because
exactly that they're trying to do.
That's probably where because that's where
yes,
and it's all IJ stuff.
Yes, IJ is a different assets, and it could stand in for A and B for a 2-asset portfolio. It could be a multi-asset portfolio. I and J is they use the term for multi-asset portfolio.
So really, it could be sigma AB. It's the same as IJ.
Sigma. Wait. No, not sigma AB.
I thought you said
AB. Okay, thank you. Sorry, I thought you said. I'm sorry. You said sigma AB is. You said it's IJ.
Right.
Sigma AB equals IJ. Right?
It's like it could be WAWB and then sigma. It's the same thing.
Yeah. After all, a multi-asset portfolio includes a 2-asset portfolio, right?
Right.
You know, it's a 2-asset
but
portfolio.
In this
it could be a 3-asset.
I and J could be easily replaced with A and B.
Yes.
Okay.
That's why. So I'm glad you asked this question. I like Kara. This is
it's
nice.
just confusing because like I feel like I get some things and then when it does something like that, then I don't know what it's trying to say. So then in this chart, the opportunity set for N risky assets.
Yeah, this is the same thing as the efficient frontier.
This is the efficient frontier again. Okay, so right, so you're trying to be as close to that line as possible.
Yes, all the guys inside those places, they are all inefficient compared to the guys on the line.
Right, the ones off the line are not efficient.
Yes, the guys below the line, yeah.
Below the line are not on the line, because then it depends on your tolerance, where you could be
below the line. Sarah, below the line, those guys are inefficient. Why? Look at that. Look at the one extreme. Look at the one just close to A.
Yeah.
The return is
right because you would.
Yeah. For the same, why would I invest?
You could have a higher return.
What? Yeah. So there is inefficient. They're inefficient compared to the guys on the line.
Right. And then depending on the opportunity set with N.
Thank you. So you said the right thing. Depending on your risk tolerance.
Right.
Depending on risk tolerance, B
is less risky, less return.
Yes. Less risk, less return. That's why you have. That's why you may need to borrow using the risk-free asset. So as to.
I understand. Let me try to explain it to you. So when you have a lesser risk tolerance and you're closer to the risk-free rate, you can borrow. Wait, no, I have that backwards. When you are more risk tolerant, you can borrow at the risk-free rate.
Yeah, I like that. Yeah.
And then invest in more risky assets.
Yeah.
But if you are less risk tolerant, then you're just basically investing at the risk-free rate.
Yeah, you lend At the risk-free rate.
lend at the risk-free rate.
Yes.
But for people who want to borrow, people who are more risk
These guys are
tolerant,
more.
they would
Yeah.
borrow at the risk-free rate and then invest in the risky asset.
Yes.
I wrote that down somewhere because I understand that's like the big thing here. Where did I write that? Because that took me a while to think through. A different book says it better than this Copeland book. Right. So if very risk averse, so use wealth to invest in risk-free assets and invest a small amount in risky assets. If less risk averse,
Less risk averse is the same thing as more risk tolerant.
more risk, you will borrow at the risk-free rate to invest
Yeah.
in a fixed bundle of risky assets at the optimal proportions. So
Yes.
somebody who is going to borrow at the risk-free to invest in more risky assets is more likely to invest more in an A, but somebody who is more risk averse, they are more likely to be in the B side because that's probably really close to the risk-free line, which I also understand the difference between the efficient market or the efficient frontier. Like this is like the efficient frontier where it doesn't give where the risk-free rate is like the capital market line does, where you know right where it is.
Yeah.
Okay. So then in the next model, the efficient set with N risky assets. Now this has the capital market line with the risk-free rate with the efficient frontier. So then as long as they're on that curved line somewhere, they're
actually borrowing and lending, right?
what?
They're borrowing or they're lending. It's a tangency portfolio, right?
Right.
They call it tangency portfolio.
And what is that M representing in this chart?
M?
That's the market line?
The market, let's see.
Or the O?
M.
What does that M and O mean?
M and O market. Let me see what do I think this M and O is? Portfolio. O. It's awesome. How can they put all this O without even letting us? I'm just going to interpret. It's best for me to interpret what this O means rather than finding. I know that O is this is definitely a worst. This is definitely a worst case scenario.
Oh, I see.
You have a
The
lower return.
it's just a
I don't
portfolio.
really know. Yeah, maybe it's a portfolio. I know that A and B, they are assets, right? C, and there are different combinations of the assets. C is obviously inefficient. A has higher returns but higher risk. B is actually lower return and higher risk. Portfolio M, that's our portfolio.
Yeah.
That's the
That's M can be identified as the market portfolio of all risky assets. All risky assets are held as part of risky portfolio M.
that what M is? Market portfolio of risky assets. Okay, yeah, sure. Yeah.
So
Tangent, and it's also the tangency portfolio.
because I feel like she could say, oh, graph to me the efficient set with N risky assets in one risk. So one risk-free asset. Yeah, this is
With one asset, yeah. The efficient set with N risky assets and one risk-free asset. We have we have M as the market portfolio, right?
Right, of risky assets.
Yeah. And we have the tangency line that tells us how we can make our combinations of M and RF, right?
That curve is called the tangency. The curve.
Yeah, that line, yeah.
The efficient frontier is a tangency. Tangency. No.
Wait, come again.
Just the curve itself, you'd call that the tangency?
Is
Or,
the curve. The curve is, are you looking at this A going to D? The indifference curve.
what do you call that?
The indifference curve.
What is it?
It's a indifference,
Oh,
indifference curve.
curve. Okay. What's the difference between the
Yes.
indifference curve and the efficient frontier?
The indifference curve, I think the indifference curve, let me try and see. It tells us how do I say it? I think the efficient frontier, it's like it uses the indifference curve
Like it just
to
doesn't
tell
matter.
you. It's almost like, yeah.
That I don't care. I don't care where I invest as long as it's along that curve. But then
Yeah.
that I guess is absent of, I think I read it's absent of the idea of emotion or like a risk aversion or not. It's all
It's saying
efficient.
that
All efficient on the indifference curve, I guess, right?
okay. Okay. And then because you're not considering other person's utility, you're just considering your maximum satisfaction, right? Okay. If she were to tell you, yeah, and then you have to explain everything there, right? So A is when you're 100% invested in a highly risky asset
Right.
with the highest form of return, and the highest form of risk. D is when you have a low return with quite a high level of risk. D is quite inefficient to A and all point on the efficient frontier.
You would
C
say
is definitely inefficient. Yeah,
D is inefficient.
D.
Oh, D.
Yes, D.
Right. So that's what's really confusing to me is I would agree. That's why this is not really, yeah, D. Why would you ever invest in D? So why is it on an indifference curve?
Yeah, it's trying to tell you that's where the efficient frontier comes in. Efficient frontier, those points below the efficient frontiers are obviously inefficient portfolios, and you shouldn't invest in it.
So this
So
indifference
anything,
curve is not the efficient frontier.
I think it's used to explain what the efficient frontier is talking about, like a platform for explaining what the efficient frontier is talking about. Because
Okay. So then
everything below the indifference curve, it does not make sense to invest in it.
below it, yeah.
Yeah.
What do you think those dotted lines are trying to represent?
Let me see. The dotted lines. Uh, I think it's almost I think it's looking it looks like the tangency line. I think it's just looking at different variations. What if you had to move from RF to A? RF to A itself. If you had to, it's different from going from RF to M. RF to M, a higher M will have a higher return. Just imagine this. Look at this point. If you go, if this dotted line from RF going up, let's say we stop at the one for M. Look at the one for M.
Yeah.
Let's say you stop at that dot. But then look at the straight line, the one that is sharp,
Right.
RF to M. Which would you prefer? M to the dot to the one just below it.
Right. I would want
Have
M because I have a higher return.
higher return but lower risk. So that line is just trying to tell you that it's more efficient to go from RF to straight to A, because you have the efficient frontier, the curve. You have combinations there that give you a higher return and the same level of risk.
Right.
So I think that's what it's trying to approximate. RF obviously has. Do you know why it's horizontal? It's horizontal because the risk-free rate is known. It's constant, fixed. And horizontal is trying to tell us that it is fixed. So you can invest at RF, put all your money there, have a fixed, it's fixed.
Right.
That is, there is no risk. No risk for a risk-free asset. It has zero risk, so it's going. It's just the moment you go from the RF upwards to M to B, you are incurring some form of risk. Going down, it means you're actually getting lower risk for higher risk. But if you are going horizontal, it means that you have no risk. There's a zero level of risk for a risk-free rate asset.
Right. And then in that next graph, page 4, it's just giving more. Actually, if I jump down to that equation, the capital market line says
Oh,
what?
the capital market line.
Right. So this is the expected return on the portfolio using
Yes.
risk-free rate, because that's the difference with the capital market line, and it's taking the expected return of the market, right? M is the market,
Yeah.
minus the risk-free rate divided by the standard deviation of.
Okay.
So this is, so when I see ERM versus just RM, is RM still the expected return of the market?
Thank you. Yeah. So it's the standard deviation of the market. Now take out those guys. Take it out. The formula is actually risk-free rate plus the market risk premium, ERM minus RF, multiplied by multiplied by the standard deviation of the portfolio divided by the standard deviation of the market. You
Right.
have
So
a higher
return on the market. It's just of standard deviation of the market.
yeah, standard deviation of the return on the market.
Oh, of the return of the market, right? Versus.
Yeah,
Hold on. So what's the so when I look at the ERM, this is the expected return on the market. And what's the difference
ERM?
between ERM and the RM?
Where's the ERM? Okay, the ERM, yeah, the ERM is the expected return on the market, and there's the standard deviation on the return on the market. Right? No risk, no returns without risk. So it is this is let's take the ERM to be the return on the S&P and the standard deviation on the S&P.
Right. So it's the same thing.
Yeah. It's the same, yeah, the same RM. It's the same RM, return on the market. Expected return on the market, standard deviation of the return on the market.
But is there a difference between the expected return of the market and the return on the market?
Yeah.
Like
they actually
in this
one
those
expected return.
numbers.
Yeah, I understand what you mean. E is actually expected return. RM is actually actual return.
Right. So
they actually
return
they actually use
the probabilities. versus this is the actual return?
No, not necessarily. I've seen textbooks, or I have seen what people I've seen people write RF plus RM minus RF. It's a bad terminology, but it's meant to be ERM because you do not know what the market is. If you know
Right.
what the market return is, then you don't need to use EE. You just need to take the RM. Thank you. RM is actual return on the market. RM is return on the actual return on the market, while ERM is expected return on the market. So let's say you already know what the return on the market is. You can actually find out the return on your portfolio by comparing the actual return on the market minus the risk-free rate at that point in time, then add it to the risk-free rate. Now see if it compares with the actual return on your portfolio. This one is expected return on your portfolio. That's how we're dealing with expected return on the market.
That's of the market, and then the standard deviation RP is on the actual return on the portfolio.
Yes.
Okay. And that so that's the expected return on, oh, this line is drawn for return tangent efficient set. So, so that's the line that they're trying to draw here from the risk-free rate up is the expected return in the portfolio. And then each of these different, like the Roman numerals, is kind of somebody's risk preference, I guess.
But come again. You said something is somebody's risk preference?
Yeah, I'm just trying to say, so that line, the capital market line, and then those Roman numerals 1, 2, 3, are those different investors' portfolios?
Wait, which page are you?
I found it. Could you explain to me what?
Where are you? Is it portfolio diversification and individual asset risk? Oh, yeah, still on
the page 4 under assumption 1. That it looks like.
Wait. Oh, okay. Is it the derivation of the CAPM?
No, I'm not there yet.
Oh, sorry. Sorry about that. Where are you? The front page.
So it was just right after the efficient set of risk and risky assets. Then I was looking at, it says, in the presence of the risky asset, all investors will prefer combinations of risk-free assets and portfolio M on the efficient set. All investors need to know is the composition of portfolio M and the risk-free asset.
Yeah.
I don't know.
Yeah, you're right, and that's what that will be determined by the risk-free tolerance. If you are more risk adverse, if you are less risk adverse or more risk tolerant, obviously you see where you get to borrow at the risk-free rate to be able to lend at to be able you see yourself borrow at the risk-free rate to get more weight on the market portfolio, to invest more in the market portfolio. So you're right, risk preference, risk tolerance.
And then could you just explain equilibrium to me, of what equilibrium is all about?
Where is it?
It's not on here. It's just in my book. It says a description of equilibrium.
Equilibrium is meant to mean balance.
So like diversification?
Thank you. Diversification, no. Diversification, no. And diversification is where you spread your risk, where you spread your risk across, if where you spread your investment across different risks, different risky assets. Equilibrium is looking at the balance, what you achieve. Okay, wait, what you achieve when there is equality between two variables. Let's say, for example, let's look at this stuff. If we look at the equilibrium here, there are different equilibriums. Look at this, what you read now, in the presence of the risk-free rate. The equilibrium is whenever the, for example, the ERP, it touches the line, right? That indifference curve, right?
The
And
risk.
it goes down.
Yeah.
It goes down. The equilibrium there is when both of them um, touch the this curve, this line. So that means that is where your portfolio will be invested. That actually, you thank you. You have equilibrium risks, equilibrium portfolio return, and equilibrium um, portfolio risk. That's what happens when you get assets. That's the portfolio you will get for that return and for that risk. That's the equilibrium you achieved at that point in time. The moment you move up, you
So
achieve another equilibrium.
M is like the equilibrium in this set.
Sorry, come again.
M portfolio would be like the equilibrium in this set.
Yes, at that given return and at that given risk. Because that's what your funds can actually do. By the time you borrow from the risk-free asset, then you're already, by the time you borrow from the risk-free asset and you lend, sorry, by the time you borrow from the risk-free asset and you invest in the market portfolio to get more, that's actually another level of equilibrium. Because equilibrium means a balance. It means that you're achieving different, the moment you achieve, let's say, quantity and quantity demanded, the moment you achieve, the moment they come together, you achieve one, and they're different, they're countless equilibriums, because they're different quantities, different measurements. We have different risks, different returns, and each time they meet, they have the equilibrium at that level. Tell me how did your note ask the question? What is equilibrium? That's it. That's it. That's what they said, right?
Yeah, if I had that question asked me, what is equilibrium? You don't know.
Equal. How would I answer it? I'm going to answer equilibrium as the level of let me see. Should I make equilibrium market portfolio? The market portfolio is the minimum variance. Is a market is a portfolio of risky asset, and it is the, what do you call it? It's the minimum variance portfolio. It's the minimum variance portfolio. It looks kind of vague. Equilibrium is just looking at it's looking at a return achieved at a given level of risk, at a given level of return and risk. Equilibrium could mean different. I know that it's the portfolio achieved at a given level of return and risk. Because if you can remember if you can remember the law of if you can remember the graph of price and demand, price on the vertical, on the y-axis, and on the demand on the x-axis, and
Yeah.
you have a downward sloping curve, you find out that when the price moves, touches the curve, it goes down. That place is the equilibrium price. Down is the equilibrium quantity because they both met. M is one equilibrium. What do you call it? RF. The moment it goes like this, It's another equilibrium because 100% of your portfolio is invested in a risk-free asset. So it's telling us the portfolio. I think the way I understand it is the portfolio that you achieve at a given return and at a given level of risk. And it could be the market portfolio, it could be A, it could be A. I mean, equilibrium it doesn't necessarily mean good. The fact that you have equilibrium, it means that you may actually just take a look at this. If, for example, what the US, the demand for supply and the demand for sugar, they created, they allowed a space for a higher demand and a lesser supply, so it will lead to higher price. So equilibrium does not necessarily mean that all is well or it's a good thing. It just means that that's the price at that point in time, and that's the demand that's the supply that can satisfy the demand. The equilibrium price will be at that level that demand is satisfying supply, and that's in this case, it's the portfolio that we get at each level of return and risk.
So then with the market price of risk
So,
calculation that she has, and it's
okay,
taking,
market price of risk,
so market price of risk
systematic
as the market, what's MRS?
MRS as the MRS between risk and return is identical. What is MRS? MRS, imagine MRS.
So it's like how much you're paying for additional risk.
So let me see. Okay, the marginal return scale. Marginal return MRS between return and risk is identical.
Oh,
Uh,
marginal rate of substitution.
oh, okay. Marginal rate of substitution. Let me see. What's the definition of that concept? The marginal rate of substitution.
Okay.
The
The
marginal
marginal
rate of substitution is the
equilibrium, the marginal rate of substitution between return and risk is the same for all individuals, regardless of their subjective attitude towards risk. If the marginal rate of substitution between risk and return is the same for every individual in equilibrium, then the slope of the capital market line is the market price of risk.
yeah. Now look at this. The market price of risk. What does it tell us? It tells you that there is a price for risk in the market.
Right.
In other words, the moment you diversify your portfolio and you achieve zero level of risk, zero level of unsystematic risk, now your portfolio will be subject to what is happening in the market.
Did you say
Because you take,
static risk?
yes, marginal price of risk is telling us that the risk your portfolio is subject to when you have a fully diversified portfolio, when you have a diversified portfolio, your portfolio is now subject to market risk.
So even if you're diversified and you're trying to, lessen your risk, no matter what, there's still market risk.
there's still a risk, market risk. Thank you. You can't diversify it away. I mean, it's not like you can control the economy. You can invest in Google, invest in the best stocks. The moment there was a macroeconomic risk, the moment what do you call it? There was a recession. Google is going to affect Google. It's going to affect all these stocks, and that's what your portfolios may not move. The returns may not move in the same way. As a matter of fact, if you invest in Dollar Tree, your portfolio could have stability because in recession, consumer good companies, people will still eat, but people can do without some luxury product that Apple or uh, Microsoft, maybe laptops, with stocks that are invested in luxury.
People still eat, but they might not go out to restaurants. They might do more
Thank you.
grocery store. Yeah.
Or they may go to lower priced restaurants, even
Right.
within. And so our portfolio is always subject to market risk, which cannot be diversified.
Risk calculation just gives kind of an inherent risk within the portfolio.
Sorry, come again.
So this market price of risk is just really inherent risk within your own market portfolio that you really can't control for, even in a very well diversified portfolio.
Yes.
Right.
And this market price of risk is telling you that what would make me invest? Why would I invest? That the market risk is also explained by a concept. What would make me invest in a risk-free asset that is certain when I have risky securities that give me higher returns? Sorry, what to make me invest in a risky asset when I have a risk-free asset with a known return? It must then be that you must be willing, a risky asset should be willing to give me a premium above the risk-free asset.
Right.
In other words, the market risk, the one that I cannot control for,
Right.
risk-free, there is no market risk. The market risk is zero. But for risky assets, there is always a market risk. If I want to invest in a risky asset, I must get more than the concept is that I
Right.
have to price in the risk. So I can't just have the risk-free asset. I can as well go and invest. You must give me something higher because I always need to deal with that market risk. So that would be a difference between a return on an expected return on the market minus the risk-free rate. And you cannot talk about risk-free. You cannot talk about return on a risky asset without talking about the risk on that market. That's why that's why you have what do you call it? Expected return on the market minus risk-free rate divided by the standard deviation of the return on the market. There's a ratio you would do. It's called Sharpe ratio.
What is it? The Sharpe?
Sharpe ratio. Yes.
SARPE?
Yes.
Yeah.
This is the same the Sharpe ratio. It's a different format in the sense that it just looks at your return minus the return on the benchmark
The
divided by
benchmark.
the return on.
Yeah. When you say benchmark, it's really is the risk-free rate.
Yeah, it could be a risk-free rate. It could be the return on the market also.
Right. So as an investor, why would this number be so important to you? Because you want to know
Yeah.
what the market risk is compared to maybe the risk within your own portfolio, or no? Like, why would you care about this number?
As an investor, why would I care about this number? Thank you.
And wait a minute, this is not on your portfolio at all. This is only just on the overall market in general.
Yes.
So they're just
Why,
the market.
why would I care about this? Thank you. Why would I invest in a portfolio that is not giving me a higher risk, a higher return for a given level of risk? This equation is telling me the this is telling me the premium I get from investing in a risk-free return, in a risk-free rate, from investing in a risk-free asset for a given level of risk. It's for the sake of comparison. This is what I'm going to earn on a average basis, what the market is earning. I mean, why should I invest in a portfolio when I cannot earn the market return? I can as well go and invest in stocks in the S&P and get the market return rather than investing in a portfolio that is giving me something lower than this. So you want to always get the market return. So let us look at what the market is earning before and compare it to my portfolio.
If I go back to that graph,
Yes.
and I see M, what would be the difference between the standard deviation or the variance and so it's like the variance of the market. Like if I had sigma RM, of the actual market, and this is I know of just the portfolio, but what's the difference, I guess, between overall variance of the market versus just this market price of risk?
Oh, okay. What's the difference between the variance on the market? Let me understand your question well. You're trying to compare. Wait, come again, please.
So this is telling me just what really the risk is within the market. So if I were to calculate variance, which I thought variance was risk, and it does have variance within here, I guess it's just taking what you expect, though. That's all right. I'm okay with it.
On average level, right?
Yeah. I'll just, so with the next section, this portfolio diversification and individual asset risk, this is a whole lot of formulas that, again, just make me scared because I don't know what they're saying. So
Yeah. You will like this one. Remember, with this one, we've done something similar. Look at this quickly. The variance on the return on the portfolio. It's trying to tell us exactly what we did. That it is a multi-asset, right?
right. So it's talking about multi-assets again, and it's really just taking the variance, weight of the variance.
Yeah, and the standard. Remember how they got that? Remember how they got their standard deviation?
Of
It
A and
was
B.
covariance divided by the correlation, right?
Yeah.
It just yeah. Now look at this. For an equally weighted asset, for equally weighted assets, it's just the same thing. 1/n. That's for an equally. If you have 5 assets, to and they are equally weighted, to get the weight is just 1 divided by 5. That's 0.2.
So
Like then it's going to be
hold on a
0.
minute. So
Yeah.
just I'm still stuck on that. I know we already talked about it, but with that first one, that it's looking at the W I and WJ. That I mean, again, it's really just the it's taking the weight squared of the variance. That's what WI is, and then of A, and then
Yeah.
same thing, the weight squared. So it's just substituting that. But then this sigma ij,
Just for different asset, it could be B.
but it's that is just replacing this 2AB
And
covariance
there
of
are more
R.
assets. There are more assets. So J, instead of putting in WBWC, WE, it just put WJ.
But it's the exact same formula.
Yes.
It's just trying to tell me that it's for multiple assets.
Yes.
Okay, so then in the next
Like,
one, it's saying that let's assume we have n equally weighted assets. So for X number of assets, they're all equally weighted in our portfolio.
yeah.
So what's the question? When the number of assets in a portfolio increases, what has a bigger impact on the portfolio variance? On the portfolio variance, individual assets variance, portfolio variance,
Will you
individual
come again?
variance.
Sorry about that. Come again.
This is the question that it's asking. So when the number of assets in a portfolio increases, what has a bigger impact on the portfolio variance of the portfolio variance?
Of course.
Individual asset variance is or covariance terms of pairs of assets. So that's, I guess, what this is trying to me.
Yes.
So assuming this, so then, yeah, like I don't understand any of these letters.
Okay, look at. Okay, relax. Okay, look at this. Um, you know why? For example, what is the variance of one asset portfolio? It is y y. What do you call it? It is I multiplied by sigma squared a. It is WA multiplied by sigma squared a. For a one
Wait a
asset
minute.
portfolio, you're 100% invested in this portfolio. So 1A is 1.
Wait a minute. For one asset though, or for two?
One asset.
I thought that was just taking.
WA multiplied by sigma squared A. The variance on asset A
Wait, how come you're using sigma squared? Is R minus ER sigma squared?
is R minus. If you go to the beginning, you see something like that.
Yeah, that's where when you say sigma squared, then I get confused. So,
Sorry,
like,
sigma squared variance of A. Variance of A. Sorry about that. Variance of A. Variance is something as sigma squared.
oh yeah, so just the variance in general. So variance
Variance, right?
squared, right? So to solve for sigma squared,
Yeah.
it's taking
So it's 1 multiplied by variance of A, and that's variance of A. So the variance of the one asset portfolio equals the variance of that portfolio. The variance.
hold on, no, you have me lost. You have me lost
Okay,
because
okay, okay. Look at this. Look at the two asset portfolio. The two asset portfolio is WA squared
yeah,
variance of A, right?
yeah,
Plus WB squared
yeah,
variance of B, right?
yeah,
But we have just one portfolio, so we don't even need to move beyond A. If you have portfolio A as the only single asset in the portfolio, we just stop at WA squared variance of A. Variance of A.
right,
Now we're actually 100% invested in this portfolio because that's the only portfolio, that's the only asset in our portfolio.
yeah,
So what would be WA? 100%, 1.
mm-hmm.
And that is 1 multiplied by variance of A. So the variance of a portfolio of one asset equals the variance of that asset.
Right,
And proven every time. The moment you add one more asset, you would always have a lower return. Sorry, a lower portfolio risk.
right,
It would always affect the portfolio variance. It will bring it down. And the assumption, remember, the assumption behind adding investment in the portfolio in the textbook, it's saying that as a rational investor, you're actually trying to diversify. So the moment you keep adding, you're adding with the sense that you are not putting. No, no, no. I don't think I should make that assumption. But I know it's almost like you are investing in different asset classes that have different risk and different return. If you are, if as in, and what do you think? Why would you have a portfolio that has the same returns? It doesn't make sense. It's the same return and the same risk.
unless they're
All you
very
need,
high.
unless they're very high, then they will not be asset A, asset B. All you need to do is it doesn't you rarely find assets that give the same returns. If you find those assets that give the same returns, then they look like one asset. They're almost like one asset. Just invest $100,000 in. Take them as one asset because why? They're giving you the same risk and the same return. So they're in the same asset class. So to diversify your risk, you need to invest in a different asset class, like
Right,
stock, like bonds, like real estate. They have different. Those guys have different risks and return, and they have less than positive correlation. Some they don't have near perfect correlation. Stocks, bonds, and real estate they don't move nearly the same way.
Right.
So that's why now where will we again? Let's see. That's why, yeah. So the question says that what happens when you start putting in investment? The portfolio variance drops. Now, is there any other option here
Right.
again? It said it's like it's mentioned another one. Is it only portfolio variance they asked the effect? Okay.
Say that again.
Is it only portfolio variance that they asked? Uh, is it only portfolio variance that they asked the effect of adding more assets? Is it only portfolio variance that they asked for the impact on when you add more assets to your portfolio? Did they ask for other effects? Did they give us more?
No.
Look at this conclusion. It says when the number of assets in the portfolio rises, the covariance terms have more impact on the portfolio variance than individual assets. This makes sense. This makes sense because the variance of a portfolio is not equal to the sum of the individual variances. No, the variances are connected by covariance. Some of them are positively correlated. That's if you invest in two assets that are correlated. Some of them are negatively correlated. So the covariance defines that either this is a positive covariance or a negative covariance. So when you're dealing with a portfolio of two assets, the covariance is more important than the variance.
Right.
In a one asset, the variance is more important because the variance of the portfolio is actually equal to the variance of that asset. But for a two asset, you're not dealing with you're not dealing with covariance. You're dealing with covariance, and covariance is more important.
Right.
Thus, the portion of an asset risk that is uncorrelated with the economy can be avoided at no cost. This is what you call unsystematic risk or unique risk.
At what?
Yes. The portion of an asset risk that is uncorrelated with the economy can be avoided at no cost. In other words, you can't, no, no, in other words, there is no price for this risk. It's not a market price. No one will pay you for unsystematic risk because you can just diversify your portfolio.
It's just on one versus systematic is on the whole portfolio or the whole market.
Wait,
Or
come again.
unsystematic risk is the risk just on one asset versus
No.
systematic risk is on multiple assets or the whole market or portfolio.
Okay. You're partially correct. For a one risk, for a one portfolio, for a one asset portfolio, you are exposed to both unsystematic risk. Why? Because you are 100% invested in this asset. If
Right.
anything happens to this asset, the money is going down.
Right.
But it's also subject to systematic risk. The things that your portfolio cannot that have no control over. But the moment you have two assets, three assets, you are diversifying away the firm specific risks. In other words, you're trying to eliminate the unsystematic risk.
Right.
So what is left in your portfolio is the market risk, the market price of risk.
Right.
And that's what investors should be willing to pay for.
Right. Okay.
That's where you so so there's difference between the CAPM measure of market price risk and the capital market line. SML, CML. The CML capital market line is ERM minus risk-free rate divided by, actually, multiplied by RP, the standard deviation of the portfolio, divided by the standard deviation of the market. By the time we go down to CAPM, the security market line, you'll be seeing
Right.
something like beta.
Yeah. So now it's getting into part 2 of CAPM.
But if you want to look
yeah.
at something, have you looked at this average covariance?
Well, now, okay, so on this next page,
Okay.
before it even gets to CAPM, it wants to do, kind of the definitions beforehand. So this is on page 6.
Okay.
When we assume an investor holds a portfolio of risky assets, I, in the market portfolio M,
This is the same assumptions of a perfect market. The assumptions of the an efficient market. One
right?
market.
So I know, yeah, the assumptions overall that we're just expecting, no market imperfections, no arbitrage issues,
Yeah,
right?
that's why you can. Yeah.
So, but when I just kind of continue to read through the notes,
Yeah.
going through, so it's starting with, again, the expected risk on the portfolio and the variance on the portfolio, or expected return, and then variance of the portfolio, right? So now instead of doing bar R, they're doing sigma RP. That's still the variance, right? It's still
Sigma RP. That's the standard deviation of the portfolio, right? Of your portfolio.
I'm sorry, the standard deviation. You're right. So this is the standard deviation of the portfolio. Okay. Standard deviation. Obviously different than the variance. No, it's the same, right? Standard deviation. I mean, this is still measuring volatility, risk, the whole thing, right? But it's this is
standard
deviation calculation.
Yeah.
Versus the variance, this sigma squared variance calculation. I know it can be derived in the same way that if you can calculate standard deviation and square it to get the variance, or variance and take the square root to get standard deviation, right? So this goes through, and now if I'm just remembering what these letters are trying to say, in the expected return of the portfolio, it's taking the weight by the expected return of individual stock. This is just for one asset anyways, risky asset 1, right? So this is just for one asset. 1 minus.
And the market portfolio. Don't forget, the market portfolio is your average that you would like to earn. There's no point investing in a portfolio that does not give you an average of the market.
Right. So you want to at least get the market. If you're below the market, then that's stupid. Right?
Yeah.
So you want to at least get.
That's why you're combining the portfolio of one risky asset and the market portfolio, so you can earn more than the market portfolio.
Right. So they're mixing a risky asset and the market portfolio. But okay, so assume an investor holds a portfolio of the risky asset I, so one risky asset, and the market portfolio M. So the M though is a whole portfolio. It's not just one asset. It's the market, like the S&P, whatever. and in proportions A% and 1 minus A. But so I don't know what those percents are.
Which one? 1 minus A? Okay, 1 minus
Yeah, I don't
A%
know
is
what
just in percentage terms. That is the
what.
weight in percentage. So it's like you invest 100 in the portfolio of risky assets as asset one in the risky asset one, and you invest 50 in the market portfolio. So the A would be 100 divided by 100 plus 50. 100 divided by 150. That's why they use in percentage terms.
What is it?
So 100 divided by 150 multiplied by 100 will give it in percentage terms, the weight in percentage terms.
So if I'm just trying to read this equation for the expected return on the portfolio, what are each of these variables representing?
Good. This is a return on portfolio looking at now they are quite specific here. They're saying that what is inside your portfolio is the market portfolio and a risk-free asset.
Right. So the first part of it, AERI, is the risky asset, and then plus 1 minus AER is the market portfolio. So
Yes.
it's saying the
The
return on
amount
the
that
plus the return on the market portfolio. Right?
yes.
That's just the expected return. That makes
Weighted,
sense. What it's
yeah, weighted return, weighted average return.
right. So that's of the risky asset. But I don't know, they would have to give me the weights, right? If I were to really do this. Or I'd have to calculate them somehow.
Sorry, come again.
What were you saying about 1 divided by 150 or something like that?
Yeah, wait. Let's say they give you let's say you invested 100 in RI and you invested 150 in RM. So weight
Oh, I know what you're
WI,
saying. Oh, yeah, I know what you're saying. Just if you had the dollar amounts. Average.
yes, so you just 100 divided by 100 divided by 100 plus 150. That will give you the weight
Yes. Okay.
for
Yeah.
so one is what you get to be the other one.
Okay. So then the standard deviation of the return or of the portfolio is
Yeah.
being whatever the weight is by the variance. So like I need to basically plug that in if it wasn't given. And I would have to calculate that variance, right?
Yeah.
And that's what happens sometimes when I read the formula, all of a sudden it will go from sigma squared to the
Standard deviation.
the bar R calculation, and I'm like, wait a minute. Okay.
Yeah.
So if variance is given, I could plug it in. Otherwise, I would need to calculate plus that minus. So then this is the variance of the market plus whatever 2 of the weight minus 1 of the weight, and then this sigma IM is, what is that? It's the 2 of them, or what? So see that last piece of it, sigma IM.
Yeah. Divided by sigma IM.
Yeah.
IM is
It's both. It's the individual risky asset in the market.
Okay.
But how would I mean, I'm trying to find standard deviation of the portfolio. So this would be standard deviation. Is it I times M, like of each? So I
Wait.
have to know the standard deviation of the risky asset and the standard deviation of the market.
Yes.
And it's times each other. So it could be, I could do sigma I times sigma M. It's saying the same thing.
No.
No?
No. Why did you say standard deviation multiplied by? Wait, what? Let me see. What do you want to get?
Didn't hear you.
Yeah, you said. I said I want to find out what do you want to get?
Standard deviation of the portfolio.
Standard deviation of the portfolio is the square root of the variance, right?
Right.
Square root of the variance of the portfolio, and here they did they said what do you call it? Squared. That's the amount invested. It's the same formula, right? But the only change there is the standard deviation of the risky asset.
Right.
The standard deviation of the risky asset. I'm trying to get. Let me see.
But literally, if I had numbers to plug this in, would it be standard deviation? Like just that, see that sigma IM?
Yeah.
Is that,
Oh, okay, okay. I see.
just multiplying sigma I times sigma M when they show sigma IM? I think so.
Let me see.
Like, could it be written out sigma I times sigma M? Is that the same as sigma IM? It has to be, right?
No, no. If you go down, you see what it says. Sigma IM is actually the covariance of return on I multiplied by the return on M. Sorry, covariance of return I.
Oh, it's a covariance.
Yeah.
Oh boy, covariance. Uh,
So the beta is actually a covariance of the
Covariance, I
beta is actually
tell me because I, you know, covariance.
sorry, come again.
So sigma IM is the covariance of the two assets of um, the risky asset and the market.
Yeah, thank you.
And you would come up with a covariance over the whole market in the risky asset.
Yeah,
Okay. So
you just do the same.
this is the covariance of the risky asset in the market.
Yeah. And remember what covariance is. Covariance is correlation. I mean, it is same thing as correlation I M multiplied by standard deviation I multiplied by standard deviation M. So that's the covariance divided by covariance, sorry, divided by variance of M. You can collect like terms. There is one standard deviation M, and you know that variance M is the same thing as is the same thing as standard deviation squared, yeah,
Yeah.
right? So let's break it down. Correlation IM multiplied by standard deviation I multiplied by standard deviation M divided by standard deviation M multiplied by standard deviation M.
Wait, multiply
Denom-
by, wait a minute. To come up with the covariance,
yeah,
correlation of I and M,
IM
IM
multiplied by
multiplied by the standard deviation of I multiplied by the standard deviation of M.
yeah,
And then you said divided by,
divided by now you know the denominator is variance of M, right?
hold on, what is it divided by?
Yeah, divided by variance of the return on the market. So and variance of M is the same thing as standard deviation M multiplied by standard deviation M.
I keep getting stuck on this.
Sigma squared, right?
How,
Sigma squared
yeah,
is the same thing as sigma multiplied by sigma, right?
yeah.
Yeah. Squared, just square the standard deviation and you get back the variance. That's what it is. So standard deviation M multiplied by standard deviation M. So cut it. Cut the one up with the one down. That means beta is also known as
Hold on, I'm not on to beta.
correlation.
I can't think about beta yet.
Okay, look,
So,
yeah, look at yeah, look
so
at the denominator.
I'm still trying to hear what you said about this. If I try to come up with
Okay,
covariance of
yeah,
I trying to calculate the covariance of IM, and it's the correlation of IM times standard deviation of I times standard deviation of N divided by what?
divided by the variance on the market.
Hold on, the variance of the market. So sigma squared
Yes, sigma squared m.
M.
Yes,
That's it?
yes. And now that sigma squared m is the same thing as sigma m multiplied by sigma m.
Right.
And remember, we already have a sigma m on top.
Right.
So let's cut it.
So then instead of
So the
sigma squared, I
yeah,
can just say sigma M times sigma M.
wait. So we'll now have
Correlation IM times sigma I times sigma N divided by sigma M times sigma M.
yeah. So let's cut sigma m and sigma m up.
Right.
So that would be correlation Im multiplied by sigma I divided by sigma m. That's going to give, in case they manipulate figures. If you're given just the correlation on return on I and return on the market, and you're giving standard deviation I and standard deviation m, you can
Yeah.
easily find it better without having to do the covariance. That's why
I
we broke
see.
it down, because they could touch numbers, they could give you this. They may not give you covariance, they may just give you standard deviation on the market, standard deviation on the risky asset, and correlation.
Right.
So you won't, and don't forget, that covariance is actually correlation Im multiplied by standard deviation I, standard deviation n. So you won't need to go and start look. You won't need to. That's actually the covariance. So it's almost like a double. All you need to do is just pick the correlation Im, multiply it by the standard deviation I, and then divide it by the standard deviation n.
Right.
Yeah.
So how
So you can. Yeah.
before I thought you said I could just do correlation was times the standard deviation of A times the standard deviation of B.
Yeah. That's
What
the covariance.
okay, and what's this one?
Yeah. This one, the beta, is telling you that
This
the
is
the uh the uh the beta, which tells us this beta is what you call the systematic risk, the market risk of your portfolio. It
right. So I'm really confused why there
why
this
we
so before
right?
looking at I sigma ij, that's covariance, right?
Yeah, thank you. Covariance.
And now this sigma im is also covariance.
Yes. Sigma ij. Where did you find sigma ij?
That was going back way back to page
No, no,
3.
no. Sigma ij is looking at. Oh, I see. Yeah, sigma ij is covariance. Okay, now, um, can you remember the formula for correlation?
I can't. The
Of course you can.
covariance of MB divided by the standard deviation of.
Standard deviation, right? Thank you. Now, covariance. Now, if you make a standard deviation below the story of formula, it will be standard deviation. Standard deviation B equals covariance divided by correlation, right? back then we were trying to look at the variance of the portfolio, and we found out that the equation summed it into the weight of I, weight of J, and the standard deviation IJ. They were just using it to make sense of the importance of covariance, because it's just a change of formula. It means that we'll still need to come and find covariance. It's almost they're trying to make use of they're trying to make things easy for the equation. But in this case, we're dealing with market. We're not looking at the variance of the portfolio right now. We are looking at the systematic risk. Remember, variance and standard deviation, they look at unsystematic risk. We are saying that
Right.
after we have dealt with the unsystematic risk in your portfolio, we want to see, we want to look at the systematic risk in your portfolio after you have dealt with. Actually, part of these things I learned is that standard deviation covers both. Uh, standard deviation covers both systematic and unsystematic risk. But we just want to look at one component after we have eliminated the unsystematic risk. We want to look at the market risk, systematic risk. That's why we're looking at beta. So we're no more so beta. That's why we're looking at the covariance of the return on I with the return on M and the variance of the market.
So when I look at this next part where it says the changes in the mean and standard deviation of the portfolio with respect to the fraction invested in asset I, what is that symbol that looks like almost like
Which one is that, number 2?
that something, whatever that symbol is in front of the E, RP, and then it's like so see where the wording, it says the changes in the mean and standard deviation of the portfolio with respect to the fraction invested in asset 1 are as followed. What is that symbol before the E? Is it like slope or something?
It's derivation.
What is it?
It's derivative.
That's a derivative?
Yeah, it's like what do you call it? It's like furthermore what to use. It's like dy over dx. They actually cancel out. If they cancel out, you are left with ERP divided by A.
Right.
So it's like a derivative.
Why did they put that in there?
They are putting that in there because we're actually saying that what do you call it? The return on the market. It's almost like it's a derivative of why did they use this stuff? They are trying to, what do you call it? Like it's like how equations translate to how an equation translates to a result. It's like a derivative.
Showing that there's the derivation of something.
Yeah.
Confusing, and I don't know what it means.
I don't even worry about those guys. It's just
and they
those
cancel.
guys.
That's fine. That's where I was like, well, what is it? When I was trying to like solve, so they cancel out, and then so just for like math's sake, when I look at so now the expected return of the portfolio divided by the weight, right? How does that derive to the expected return of the individual asset minus the expected return on the market? Like, I don't get how that equals that.
Yeah. Now we need to look at what really.
Oh, I get it. Because the expected return on the portfolio, no, I don't get it. Because divided by the weight. So if the whole weight A is just the weight. Okay, I get it. A is just the weight of the risky asset because 1 minus A is of the market. So then it's taking the asset minus. All right, I get how it is derived. Okay. So all this is saying is it's the expected
Okay.
of the. So this is going to your point about saying why would you invest in this additional risk if it's not going to yield a premium to the market? So it's the difference between the risk in the market of that individual asset, right?
Yeah.
Okay.
And look at this. I found out the changes in the mean and standard deviation of the portfolio. That stuff before is actually known as change.
Right.
Change in the mean deviation with respect to the fraction invested in asset A. So let me see. As follows. Let me see. That stuff. It's a there. This is the. Let me see. ERP divided by weight. If I divide ARP divided by weight, it's going to bring it up. It shoot it up. And it said the changes in the mean and standard deviation portfolio with respect to the fraction invested in asset I, okay, are as follows. Oh, I see. You get you made an important point. You talked about what would make us invest in the risk-free in a risk-free asset, right? In a risky asset, right?
Right.
So the moment we have uh why as in why are we going to have a change in the mean and standard deviation of the portfolio? It has to do with the amount that we invest in the asset.
Right. The
The
riskier.
amount, yeah. And we're comparing that to what we get from the market.
Mm-hmm.
What is RZ? This is another term. We need to okay, let's assume that portfolio A and B have the same expected return ERZ. Let me go look for oh okay. ERZ is a zero beta portfolio. See, this turn on the market has a beta of 1. Must it cover there?
Um, if it has a, what is it? The correlation coefficient?
Be on the market. It has a beta. ERZ is the expected return on a zero beta portfolio.
Zero beta. Okay, hold on. So maybe we can jump right to beta. So then on the next page, so then so the market, the slope of the tangent of the efficient for, oh, this is just a zero. On this next page, it says,
The slope of the tangent at the efficient frontier at point M, but don't forget the slope of the tangent is what is when you decide to take. Okay, I get what this is. But these people are playing with the well, they are playing with the use of terminologies here. Remember back then we looked at the slope of the tangent for the risk-free asset, right?
right,
And the market portfolio, right?
right.
If you remember, it was equal to ERM minus F
Hold on.
minus R
Where is that?
minus RF divided by the standard deviation of the market.
Right.
See, it's the same thing.
That
But
slope.
because,
That was the slope?
yeah,
Wait a minute. This,
like
I thought
different
that was
combinations.
the expected return of the portfolio. This,
Yeah, on the right side, divided by the standard deviation of the market portfolio, right?
yeah,
This
that
one
was,
is for what happens if you have a zero. Oh, a zero beta portfolio portfolio is actually, I think it's zero beta portfolio is the free asset.
Is risk-free?
Yeah. Portfolio. Does it move along with the no? It has no risk attached to it.
No risk if the slope is zero, right? Because it's just on the line. There's no risk.
So it's actually zero.
Zero is no risk.
Yeah. Let me see. Let me look at that stuff. Let me see. They said no risk-free asset. Extensions of the capital asset pricing model. Let's assume that portfolios A and B have the same expected. Oh, okay. So the market portfolio, when you have a zero beta, it's because they are uncorrelated with the market portfolio. And that's the same, it's the same way the risk-free asset looks like, right? It has a zero horizontal, no risk. And when you have something that is not correlated with the market portfolio, um, it's almost like it has a zero beta, and beta captures the sensitivity of your portfolio return to the return on the market. So because a risk-free asset has a zero risk, or if you have an asset in your portfolio, a risky asset that is uncorrelated with the market, it means it is not sensitive to the returns on the market. So I think that they have they have almost like the same concept.
So okay, so when we're looking at beta,
Yeah.
it is the sigma im divided by sigma squared m, but sigma im is,
Covariance
so we need covariance.
of the asset, return on the asset, and the return on the market.
Right.
Looks at better looks at the systematic, better looks like the market risk of risky asset A.
So
It's telling
here's
us the
what
risk.
I don't get confused about with beta. So beta, maybe, can you just say that again, what you're just saying? So beta, could you just,
Okay.
I kind of generally know, but could you just define beta for me?
Beta is a measure of systematic risk.
Right.
It is a measure of the sensitivity of the returns on your portfolio to the returns on the market. It is a measure of systematic risk. It measures the sensitivity of the return on your portfolio to the return on the market. And the beta of the market is 1. If you have greater than 1 as a beta, it means you have it means you have above average sensitivity to the market. That's why when Google,
If
that's why
beta, if beta
a beta
equals 1,
is greater than 1,
yeah, it is greater
which
than,
is the beta of the market, you have it means that your portfolio has above average sensitivity
right, right.
to changes in the market return.
Hold on one second.
To it. Yes.
Above average or above?
Above average sensitivity to changes in the market return.
So when you have a beta above 1, so your beta is 1.2.
Yeah.
it means that your portfolio, okay, so if you have beta of 1, it acts the same as the
Yeah.
market,
Yes.
right? So when it is, so do you want 1 or not necessarily?
Yeah, thank you. It depends. Thank you. But that is why, and there was something here that looks like the portfolio beta. Can you go there? The portfolio beta is the weighted average beta of all the assets in your portfolio. That means it is WA multiplied by beta A plus WB multiplied by beta B. The beta on asset B. It's in this place. Did you see it?
Where is it in my thing?
Yes, it is. Okay. Go to go to page
Oh,
7.
7?
Yes, properties of the cartel.
Okay.
The beta of the portfolio is a weighted average of the beta of the assets in the portfolio.
Right.
So BP equals A, which is weight on of asset A multiplied by the beta of asset A plus B, weight of B, weight of asset B multiplied by the beta of B.
And how do you calculate just beta in the portfolio
Okay.
without the market, like beta of just one asset, right?
The beta of the assets will be, let's now go back to number 1, the first property of A. It will be covariance of return on A, covariance of return on asset A, return on market, divided by the variance of the return on the market.
Hold on.
Beta B, yeah,
So if so, define
beta A,
yeah beta A.
yeah,
Right. Hold on.
beta A equals covariance RA/RM divided by variance on the return on the market.
Oh, so for beta A, you're still including the market.
Yes.
Okay. So
Remember,
for
yes.
beta A, it's the covariance of RA/RM divided by the variance of RM.
Yes. So beta B. So what will beta B look like?
Covariance of RB,
Mhm.
RM divided by variance of RM.
Yeah.
Now here's a question. So to calculate the variance of, or the standard deviation of IM, obviously that's what I get confused with to calculate the covariance. And you gave me the how to calculate the covariance when you don't know the covariance, right? But if you know if the covariance is given, then it's much easier because then you can just follow this formula of the covariance
Yeah.
R. But if you don't know the covariance, that's when you have to look at the correlation and use the standard deviations.
Yes, that's why we now have to go back to that place.
Right. But if the covariance
Mm.
is just given, then that would
Yeah, you
just make
just put in the,
it easier.
or if you don't have the covariance directly, just multiply. Just remember there was a shortcut. If you are giving correlation and you are giving the standard deviation of the asset and the standard deviation of the market, correlation divided, sorry, correlation AM multiplied by standard deviation A divided by standard deviation M,
Right.
like the way we broke it down.
Yeah. So then this, you just do the covariance of RI or variance of RM. But it's right. Okay. Holdings are in okay. Right, because I think for right, so then when you look at real cap on this is that. Where's, eight, nine, 10. Where am I missing? Just the regular, kind of the standard. Oh, right. This. This is this ERI, expected return. I mean, that is capital.
Wait.
Divided by this is beta. Right, and usually I just
yeah.
Okay. Times beta. Okay. And then what is so with this empirically RI? What is RI? Just the risky investment?
RI is risky. Yeah, RI is a risky asset.
Risky asset. And then what is and then A is the weight of that asset plus what is BI, the weight of the other asset?
Yes.
So that could be the market or whatever it is. Times when you just see RM, this is the actual market versus ERM. Right?
No.
Oh.
Yeah, that's true.
So that's RM is the actual market. And then this epsilon, what is that denoting? Plus EI. Right, E is epsilon.
Which one is that?
That EI?
Okay, EI is the residual error. Anything that is not, any return that is not explained by your portfolio.
What is it again? The residual error?
Sorry, come again?
It's the residual error?
Yes. This is what happens after you have ended, after you know the return on your portfolio and after you know the actual return on the market. You now decide to take out RI. Let's say your RI, right? You know that your RI equals the risk-free rate, right? Plus beta multiplied by ERM minus RF. You know that's what the CAPM is.
Right.
You now deduct that RI from your actual return on the portfolio. If you have something greater than 0, that's going to fall into E. That's the residual error. The CAPM actually says it's the return on any security, any risky security, and a diversified one for the matter, because it actually looks at a diversified portfolio. Because the moment you start mentioning beta, you're actually saying that asset is diversified, that portfolio is diversified. So it's the return on a risky security.
It's the return, like the premium.
Yeah, ERM minus RF is a premium, market risk premium. That's the price for investing in risky asset.
But that's not what EI is.
It's actually actual portfolio minus the return that is explained by the CAPM. It's
okay, so it's actual. Okay, that makes sense. Actual, so just RI.
Yeah.
That's an actual return minus the expected return.
Yeah, ERI.
Yeah. Right, so it's the difference. It's how off CAPM was to the actual return. Okay.
Sorry, come again.
The residual error is how off how off CAPM is, like how incorrect CAPM is compared to the actual.
Yeah.
And is that E? Is it epsilon? Is that how you say it?
E. Okay.
Greek? I don't know if it doesn't matter.
Okay.
All right. And then what is number 2 trying to say, which is sigma squared I as the variance? It just
Number 2, which is that?
is the variance of return.
Where is it?
And what the heck is sigma squared E?
Sigma squared. Let me see. Let me see. Where is that? What page is that?
This is on 7, properties of CAPM number 2.
Wait. A bit lost here. Okay, the second properties. Okay, yeah. So that's the variance of the risky asset, right? Equals the variance equals A plus B RM plus EI. Okay, which is equals to BI squared, return on the market, okay, plus variance on E, which is the same thing as BI variance on the market plus the variance of the error term. I see. Now, can you remember? Let me see. The variance on the risky asset is a function of the variance on A uh, plus B I, the beta of what do you call it? The beta of the asset multiplied by the return on the market, your error, which is equal to the beta, which is equal to squared beta on the asset multiplied by the variance of the market plus the variance of the residual error. The way I look at it right now, let me try and see if you can explain this stuff. According to the CAPM, looking at two sources of variance. One is coming from and one is coming from the error term, something that is not related to the market, right? So there is one, because we are looking at beta this time. We are looking at just systematic risk, the risk that is accounted for, and the sensitivity of our returns, the returns on our portfolio to the returns on the market. That's what we're looking at. We're not looking at the variance of the portfolio, standard deviation. So because we are looking at, because the CAPM looks at beta and is tied to the returns, the sensitivity to the market, we're saying that the what do you call it, the variance on your portfolio, the variance on this asset is going to be related to the variance on the market and the variance on what is not related to the market. And what does beta look at? Sensitivity, right?
Yeah.
So the sensitivity on your portfolio multiplied by that of the market, but multiplied by the variance on the market plus the variance on an error term. I need to look at I can provide a more better definition of this. I have a better I have one in my CFA textbook and it was accurately broken down. So I can explain this better. But
that's all right. I think for now,
I think what I understand from this formula is that why we're not dealing with the standard deviation of the portfolio is because of the concept of beta. because beta is relating to the market, our portfolio, the sensitivity of the return on the assets, return on the market. That's what we're not looking at. We're trying to compare this beta with the variance on the market, and anything that is not explained by the market, that's to be explained by an error that is unknown.
Right. Right. If it's not explained by the market, then it's an
It
unknown.
will be explained by E. That's small e.
If it's
That
not explained by E,
if it's not explained by the market, it will be explained by something that is unknown,
okay.
residual error, and that's like a variant of the residual error. In in perfect market, zero. In regression, when you get to, I don't know if you do regression analysis. If you do regression analysis, one of the assumption of linear regression says that the variance of the residual error is zero. So this will be zero, and that means the variance of the risky asset will be equal to beta squared multiplied by the variance of the market.
Right.
It assumes that the variance of the error term is zero. If it's not zero, that's trouble. You know what?
All right. And then just
You know what? Yeah.
go ahead.
If if it's not zero, it's trouble in the sense that if you are to look at a portfolio, sorry, if you are to look at, let's say you are trying to predict the US S&P, right? And you
Right.
look at two variables or more than two variables that help to explain it, and you knew that the error term was something that was not being captured by your model, the moment, I mean, you wouldn't like a situation where your model is not capturing the full picture, which is
But
in
the
essence.
thing with the model itself, I mean, it does have these
Thank you.
assumptions. You know, they are thinking that it's the efficient market hypothesis, or the what is it called? Yeah, the efficient market hypothesis. You know, that the market is perfect when we know
Thank you.
it isn't.
Yeah. So actually, this stuff actually exists. It's actually equal to. It's not equal to zero. It's actually, that's why you have many times when they publish a research or they publish a statistic, they always say subject to an error -2 or -3. It shows that there could be some fault in this, something that we are not capturing. Another factor that is being, that's even, look at the global financial crisis.
Yeah.
We never thought that there would be a contagion that would affect, that would translate into the developed market and even cause the financial market in developed countries to experience such a reaction, overreaction. So that was a error term that was not captured.
Mm-hmm. Mm-hmm.
So this stuff actually assumes it's zero, but in actual sense, it's not actually zero because some things don't make sense. Like there's taxes, there's transaction cost, you know. But everything is kind of, if you notice in the market, Kara, sometimes these hedge funds or S&P is actually, they say that the return on active management is not beating the market. So why actively manage your portfolio? Why give it to those guys? That's why the transaction cost is falling seriously for hedge funds or active management because they actually, after when they get their returns at the end of the day and they take out transaction costs, they're earning less than the market. So it has really fallen because you can just invest in S&P Vanguard or invest in S&P ETS and
Yeah.
get returns better than active managers.
Right. But that's because of the error. You can't bank on that either.
Yeah.
Right. Um,
Arbitrage, by the time we get to arbitrage, we would see that in arbitrage, one of those stuffs, that constant, it looks they tell it they term it the skill of the manager, unique skill of the manager. And then the one that is not captured by the unique skill of the manager may be captured by the market or may be captured by an error term
right.
arbitrage pricing model. What am I going to say again?
So on this next page, um, with the no risk-free asset, the extensions of the CAPM, what is this trying to say? So it's saying, let's assume portfolio B have the same expected returns and are both uncorrelated with the market price with betas of 0. So when beta is less than 1, it works. So let's say if the market is going up and you have a beta of less than 1, your portfolio is going down.
Yeah. The bit once the
Is that right?
remember, thank you. You pointed out two relationships. If the return on the market is going up, if your beta is less than 1, you will have less returns.
Right.
If you have beta greater than 1,
But the market could be going down, and
yeah,
if your beta is less than 1, you could be going up. So it's not.
yeah,
It just, yeah. So it doesn't
yeah,
mean if you have a beta below 1, it's not necessarily a bad thing. But you're almost. Are you kind of hedge is the word, but you're thinking for this particular investment, the market's going to go down.
yes. That's why you're trying to manage your portfolio in a way that it will have a. When you find out that things are not working well, you quickly adjust your portfolio assets to have a beta less than 1, so that they will not react over. As in, once the market falls, your beta can react less
Right.
and have a, like, a cushion.
Yeah. So when the market starts falling,
Yeah.
you would prefer betas less than 1.
Yes.
It just has the inverse. Okay. So if the beta is 0, there's just
Beta
no relationship to the market.
no correlation with the market, and it must look like a risk-free asset.
Ah,
It has a zero beta.
yeah.
It has zero risk.
Uh-huh.
The return is known. It's actual
Okay.
return.
So literally, if you had 0 beta in your portfolio, you just really have 0 risk. There's no risk. That's like,
You're actually, yeah. Let me now see, is there anything that is uncorrelated with the market? That is like a risk-free asset.
right.
Yeah, because it's almost like you're invested in treasury bills.
So this concept of the minimum variance 0 beta
Yeah.
portfolio, you're trying to, it's
Portfolio.
right on that. Oh no, it's still, where is
Let's
the,
assume that portfolios A and B have the same expected return and are both uncorrelated with the market portfolio. Since they are different, one has a higher standard deviation than the other, then B is called the minimum variance zero beta portfolio. It is okay. The B is called, I mean, it's the minimum variance. I guess it's the portfolio that has, okay, the one with the lowest risk, right?
lower, they have the lower risk.
With the lowest risk. If you're invested in a portfolio
The same return of
with
0. Wait, so
yeah,
that makes sense.
the one that has bet, the one that has beta of zero. What would that portfolio be called? It depends. According to this guy, they're calling it a minimum variance zero portfolio because they feel that you should invest in a portfolio with full of return. Happens to be that this is market,
All right. Okay,
and it's still the same. It's still the same. So they use RZ as the return on the zero beta portfolio.
so now when there's, so just jumping to page 9, the bottom, where it says it leads to this equation. So if you have, this is when you don't have any risk-free assets within your portfolio. That's the expected, this ERZ, expected return
Yeah.
on equity. This is because then there's just no, there's no risk-free asset like in the normal CAPM. It's just taking the market minus this portfolio of RZ.
Yeah, the asset. Assets then
Divided
would be
by.
the return on the portfolio.
So what would this be? Just kind of a different, like why would somebody not carry any risk-free assets? Are they I know it's in one of these articles, this Black 1972 article has,
Okay.
they did this, but like what's kind of the idea behind it?
For a zero beta portfolio?
Yeah.
A zero beta portfolio is still, let me see. A zero beta portfolio is a portfolio that is not a zero beta portfolio is a portfolio that, let me see, we said it's a portfolio that has it is uncorrelated with the market.
Right.
Let me see. Why would somebody want a zero beta portfolio? No sensitivity to the market at all. I think it may feel that the market is
Inefficient.
I think it depends on the preference. If you do not want any exposure to the market because you feel that the market is not doing well, or you feel that uh, you can invest in let me see, can we look for a life scenario? Anything that is outside the market? Uh, let me see. I, that is uncorrelated. That is, any change in the market will not affect the movement. It doesn't. Let me see. Let me see. Why would somebody want that? I think it's just exposure. Because let's look at the case of Apple, right? And the reason why you would want to invest in Apple is because if the economy gets better, persons will have more, persons will be able to, persons can take on more loans, or if they feel that their disposable income will rise in the future, or they have more salary, they can buy more Apple products, right?
Right.
That already, that Apple will increase, the Apple stock will increase more than the market. It will beat the S&P returns because of the kind of business model. They have a better greater than one for sure.
Mm-hmm.
So if I'm saying that I do not want any, it means that is there a better portfolio? I don't want any exposure to the market. It's like they're trying to cut. I'm thinking that it's almost like you're trying to pull away from the market. You don't want any. I think it's almost like you don't want to outperform the market, or you probably that the market is able to provide you with what you're looking for. I can research on that and get back to you.
Right.
Trying to start playing around with better grade, and it means that you're trying to achieve exposure and minimum or less than exposure, less than average exposure. But the moment you have zero, it means you have no exposure. So I'm going to find out the implications. I'll find out and I'll let you know. I'll
So let
look
me
at
go
that.
on to about empirically testing CAPM and sorts of these assumptions. What would RIT mean? So they say the empirically testable form of CAPM starts with the assumption that assets rates of return are fair game. The expected return of any asset equal its average realized rate of return. So if I'm trying to
Average covariance. What page is that?
this is on page 9 at the bottom, empirical test of the CAPM.
Happened, right?
So it kind of, I mean, we could probably just jump right to when on page 10, when CAPM is empirically tested, is usually written in the following form. So this RPT denote
Let me see.
return,
Return on the portfolio at a particular time.
what point in time?
Yeah, point in time.
Point in time.
But no, P is actually, yeah, thank you, point in time, yeah.
And then, so then they're doing, what is that Y, what is it called?
Y, Y is, oh, let me see. Is it lambda? I don't even, that Y, I think, at this exposed return.
What is it?
Exposed,
Ex post?
yes.
What does that mean?
Something that has happened.
Oh, so how come they're saying the hypothesis is that
Actual.
it equals 0?
So it's Y0, the intercept that has happened, Y1, the intercept, the what do you call it? The independent variable. Y1 is in this case is RMT, the market risk premium, the actual market risk premium.
Oh, so
Multi-
this they're putting into a linear equation.
yeah, it's actually a linear equation. Can you remember the CAPM? The
CAPM
risk-free,
is a linear equation.
yes. The return on a risk-free security is a function of the risk-free, is a function of the rate of the rate of return on a risk-free asset plus the market risk premium, which is the expected return on the market minus the risk-free asset adjusted for the sensitivity of the asset returns to the changes in the return on the market. B
So they're saying RPT.
is actually a function of YO, which is what would have happened if Y1 was zero.
Wait, what is FT? So Y1 is RMT, which is the return on the market, minus what's RFT?
Return risk-free rate at a
Oh,
particular
that's the
time.
risk free. Oh, whoops, risk free. So this is the return on the market minus the risk free rate. Okay. And then beta of explains the rate of return on the beta is the only factor that explains the rate of return on the risky asset.
Yeah, the return on,
And then
yeah.
why? So why are they?
Why? Why? As in, why are we? This is an actual. We're trying to test the CAPM when it has happened. So Y0 is actually the actual return, actual beta, actual what do you call it? in the market. It is actual return in the market if risk premium. If the market risk premium is equal to zero, that is what we're earning in the market is actually what we're paying out on a risk-free asset. It actually means that if there was no market risk premium, if risk-free asset was the same as risk-free return, if the return on the S&P was the same on the risk-free asset, like a treasury bill, 3 months, then it means that we're just going to earn the risk-free rate of return right now, the one that we know right now.
So, but it's not always zero.
Yeah, it's not always true. But then this is empirically tested. This
So
is
it is
empirically,
whatever.
yeah. It could be if it's not if what we are getting on our portfolio is different from this, then there's a residual error.
Oh, okay.
That means the ex post is different from the ex ante. We call it ex ante, expected.
Expected is the actual is different than the
Ex ante. Ex post is different from the ex ante. ANTE. That's I remember they used to use that for expected.
okay. I'll have to think about that one. And then the last piece for this topic is the arbitrage pricing theory. So CAPM shows RI depends linearly on a single factor RM. Yes, okay. And then the APT provides a testable alternative. It assumes RI depends on many factors. Because they would think, right, if you follow this theory, you want to test your return, you're thinking that the market's not efficient.
Yeah, it means that the market is not captured by the. It means that the
That
return
it's
on a
not
risk-free
what?
asset. It means that the return on a risk-free asset, sorry, the return on a risky asset is captured by more than one risk-free. It's captured by more than, but let me see, it's captured by risk premiums other than the market risk premium. In other words, there are other routes to pricing. You can you will not just be looking at the market risk premium, the market risk of price, the market price of risk. You also be looking at maybe the risk from including a small company stock in your portfolio, small cap, or the risk of involving a large cap stock in your portfolio, large cap, or the risk of involving a stock that is a private from a private company. That could be marketability risk, or it could be the risk of let me see. It could be the risk of investing in a growth or a value stock, having high dividends, having no dividends or high dividends. So it's saying that the market is not able to capture, the market does not fully capture all those risks. The S&P. Yes, the S&P have uh, it's combination of 500 blue chip stocks. It does not capture anything like S&P. It does not capture. That's why you have
What are blue chip stocks just like that are on the S&P?
they're large stocks, large companies.
Large.
So it's only for the S&P does not tell you the risks on doesn't tell you the risks of investing in a small cap. Because why would I invest in a small cap stock when I can easily invest in a blue chip stock? Saying that the inefficiencies, all analysts are focusing on blue chip stocks and they are not focusing on small cap stocks. which is leading to price inefficiency,
Right.
what do you call discrepancies. So, and they tested that the return on small cap stocks is actually greater than large cap stocks. Why? One of the reasons is because they're covering these large caps. So many analysts are focusing on S&P 500 and they're not focusing on smaller company stocks are performing stocks.
Right.
The moment the higher the higher the number of analysts covering a stock and capture profit, abnormal profit from this. Um,
I would have thought the more analysts covering a stock, the more efficient the price would be, because I don't know, just with information and
a more efficient, but the less.
oh, you're kind of breaking up.
Can you hear me right now?
I can hear you now.
Okay. It means that the more efficient, like you said more analysts, more efficiency, right?
Yeah.
That's why there will be no room for arbitrage. Arbitrage will be
More,
less. Yes, there will be less arbitrage.
less arbitrage with more traders, more more analysts.
More efficiency.
And when you say arbitrage, you mean differences, let's say, between NASDAQ and New York Stock Exchange, like that, the price that you could capitalize.
Yeah.
And
Or it's
I was reading that, I mean, it's really hard to do because, especially, in the big analyst firms, there's software to just capture that. Like if there is a price difference, and since there are so many analysts at these big firms, that it's like near impossible to
yeah, it won't last for long. You cannot do it. You cannot do it. Keep doing it because everyone is going to do it.
right.
If you are buying low and selling high, others will jump into it. Before you decide to do it again, you can buy and come and sell at a loss. Arbitrage has been completely has been is zero, you know, because of so much players.
And now with technology, it just seems like it's
But
not
then
really
make it technology could make it easier to find. As
right. That where then so many, if everybody's finding it, I mean, you're not gonna, I don't know, just
yeah, technology.
it's interesting.
So arbitrage
All right.
is actually
Yeah.
different factors, right?
Right.
So also looking at
So
even the ones that is captured, that is not captured by everything. Error term.
the errors, right? And that can be from information asymmetry, somebody gets
Thank you.
information, or you're able to capitalize on it sooner, quicker. What other things? I mean, other things, I'm sure. But all right. Well, thank you for spending so much time with me today. This was extremely helpful. I'm going to write up all of my notes on this topic, and eventually I'll look at the problems. But I think I have other topics, like the next topic that I've been looking at is Black-Scholes and all of that. So I don't know what is your availability during the week?
Okay, during the week, let me see. Let me look at this. Monday, Tuesday, Wednesday, Thursday. Will Thursday be late?
Thursday?
Yeah.
Oh, you have no availability until Thursday?
Yeah. Yeah. I programmed to do some work. I kind of it will it be late?
Late, like the time of day?
Yeah, as in, will it be late for you?
Oh, there's. I would love to use as much of your time as possible. Um,
Okay, let me see.
like
How
as
about let me see. How about we do give me a second, let me see.
or I don't know if
Nine,
we could
10,
set
12.
up like a actual schedule for the next couple of weeks based on your availability. 'Cause like I said, the next topic, I feel like I'm a little stronger in. It's just again the some of the strategies. Like this is looking at the binomial option pricing, which I'm getting really confused with.
You like that? You like it?
Now that I'm
You like
understanding, I've done it before in Excel, but now I'm trying to do it by hand, and I'm just getting confused with what each thing represents. So it's looking at that and all the formulas, looking at like the ethos process and ethos NEMA and the and then the Black-Scholes model, which is just getting
it?
into
Options.
calculations. When I've used it before, I've had models that were already built, and I can just plug everything in, and out would shoot a number. But
Yeah.
this is, so then there's that in this topic, and then the volatility kind of, which again, I understand. I think at the high level, it's just when it gets into the calculations. So that's the next topic that I have, and then the other topics get into interest rates and debt, which I feel okay with. Again, just kind of some of the calculations and just really not strong in. And then it gets into futures and forwards and swaps, um, which so for the next topic would be the derivations of Black-Scholes and the option pricing. So again, I would use any time that you have, as much time as you have, because I'm definitely in a cram kind of mode right now. And then once I got through these topics, I'd love to go back and work through some of the problems. As on your tiers, trying to think, because I can't think through flipping everything. I'm okay with learning a specific equation, but then I have to think about how it flips around. I just have a hard time. But anyways, we need to kind of stick to the topic, I think, in her notes, and then get into the rest of it.
Yeah. I like the questions that we could do like questions, it'd be nice.
Yeah,
Sense
this
of
was
all.
good for me to understand. Yeah, but eventually I'll need to get into the questions.
Yes, yes, yes. Wait. Can you actually see me like this?
What?
Can you see me? Are you able to see me?
Sorry, when do you think you would be next available?
Okay. Let me see. Let me see. Can we do Thursday?
What?
It's Thursday. Can we do Thursday?
Thursday. Thursday is your next time.
Yes.
I'm on Thursday.
Are you available on Thursday? Okay. Can we do can we do let's see. About 7 to 9.
Sure. And then could I just even book more of your time? As much time as
Okay.
you have this week.
Okay, let me see. Um how about Saturday?
Okay.
Saturday, let's see, um about 8 o'clock to 10:30. Is that good?
Okay. And then how about on Sunday?
Sunday, let's see. Sunday, um This is Sunday is how about we do same time?
8 to 10:30. Okay. Yeah, and if you ever have any other availability, I would take it. So if you look at your week and you're earlier, you have any time before Thursday, I would definitely take it.
So what topic are we going to cover? That means we're going to next time we're going to be looking at black schools and trying to work in
Yeah,
public.
So for now, I'll send you her topic notes on it, kind of doing the same thing, just kind of reading through her notes. And I've been through them already. I'm going to read the book in more detail for that too. And then just as you've done today, kind of walking me through it, answering the questions that I can't figure out myself. So I'd love to be able to get through that topic. Hopefully more, I feel stronger in that topic than this topic.
Awesome.
Hopefully we can move more quickly through that. And then also with the interest rates, I just need a refresher. Like I haven't been through that topic yet, so I'm going to refresh myself on that. But I'm thinking ideally if on Thursday, topic 2, and then maybe Saturday and Sunday is devoted to topic 3 with the interest rates, and then next week looking at topic 4 with the forward contracts and futures. That might be a good schedule. But again, if you have any other time, I would definitely take it. So you could shoot me a text or email if anything opens up for you. So I can be pretty flexible.
Okay. I'm going once I get the budget, I will definitely go. But definitely have Thursday, Saturday, and Sunday, right?
At the night, yeah. Anytime. I'm like devoting myself to this stuff. So whenever you are free, I would take any time you have extra.
Man, you are really working hard. Oh man, you are really working hard.
Sorry, what?
I said you're really working hard.
It's hard. I mean, because like I said, I'm an accountant. My background, I'm CPA. But this stuff is not accounting by any means. So it's really throwing me. But I'm determined to get through it. But I definitely need help. So I appreciate it. You're very smart, and I wish I could be to your level. I'd say one day, but I just need to get through this. So I'll let you go. Will you send me like a PayPal?
Okay, let me see. Um, I wanted to do it through the profile. Is that gonna be costly?
I think the problem for you, I've used Wyzant tutors before. When you go through Wyzant, I think they charge you a fee. So even though I pay a certain amount, you only get a portion of it. But I think if you set up a PayPal, it would all go to you.
Yeah.
So it's up to you. I'm fine with whichever way you want me to pay you.
I'll go with Wyzant.
Okay. And then I rate you through it, and then you get like points or whatever. So yeah, if you want to set it up through there and send me the link, then that's great.
I'm really grateful.
How do you pronounce your name? Is it
Taiwo?
Taiwo? Thank you. I wasn't quite sure. Now, and you live right in New York City?
Yeah, I live in New York City and just Brooklyn.
Cool.
Yeah, Brooklyn. So it's amazing. You're doing so much. Your determination is amazing. It's amazing.
That's all. Luckily, I teach accounting, so I have the summer almost completely off, so I can really focus on this study. So I'll let you go. And again, if you have any time before Thursday, just let me know, and I'll be available. But I'm obviously going to keep at it, and then hopefully can ask intelligent questions on Thursday.
Yes. We should do a lot of once we get through this concept, we now need to do questions so that we make sense of everything, all the concept and any.
That's the thing for me is if I can have numbers.
Yeah.
But Yeah.
Yeah.
All right. Well, have a good night. If you end up having any, no, actually tonight I'm going to refresh myself in all of this. So I'm going to take a break.
Yeah, please do.
Go
Please
through
do.
all this. Yeah. All right. Well, thank you so
So
much.
so with let me see. I'm not going to let me see. I think we just spent 4 hours. I think we
Yep.
just spent 4 hours, right?
Okay.
4 hours, okay. I hope the price is fine. I hope I'm not overcharging you.
No, I mean, I I am desperate. So I mean, it's a lot for me personally, but you're great. So you know, I need your help. So it is what it is, I think.
Okay, so we'll definitely make progress.
Okay. Well, thank you. I'll
Yeah.
talk to you on Thursday. Thank you so much.
All right, rest up.
You too. Thank you. Bye.